Hello and welcome to day 2 of the forum. Thanks very much for joining us today too. This morning we will look at 2 more structural forces shaping Europe's future. First, people. Migration has long been central to debates about the labour market, but its implications for productivity, investment and long-run growth are less well understood. Second, we'll look at money itself, specifically tokenization, which has the potential to transform how payments are made, how assets are held, and how the financial system is wired together. Both sessions will be chaired by members of the ECB's Executive Board. The first by Boris Vujčić, our Vice President. The second by Piero Cipollone, a member of the Executive Board. Mr. Vujčić, the floor is yours. Thank you.
So good morning. We have another very interesting topic on the menu, migration. As you know, Europe has seen quite a lot of immigration over the last years, and it's not only interesting economic topic, it has been for a while, but it's also a very important political topic in Europe, as you know it, because these migration flows have also shaped the politics in many of the European countries. So that's why it's very important to have new contributions from people who are experts in migration to tell us how the migration impacts the economic outcomes in Europe. There is, I would say, no consensus yet in the literature on exactly how migration affects the employment, the growth, productivity. There are interesting discussions on the short-term versus the long-term effects, on the natives, on the wages, employment, unemployment, differences between the push migration or a pull migration on the unemployment and the employment and wage outcomes. But we're going to have a new addition to the discussion by Giovanni Peri, who is the Brian Cameron Distinguished Professor of Economics at University of California, Davis, and he's the founder and director of Global Migration Center. He will present the paper which will be discussed by Hillel Rapoport, who is a professor of economics at the Peri School of Economics, University 1, Pantheon-Sorbonne, and he is also a co-director of Research Policy Network of the CPR on migration. So 2 experts on migration, 20 minutes for Giovanni, which will be followed by 10 minutes discussion by Hillel. Giovanni, the floor is yours.
Thank you, Boris. Thank you for being here. Thank you, Chairman. So yes, today I will talk about the impact of immigration on growth, essentially. And this is work with Gaetano Basso at Banca of Italy and Mitali Mathur, who's a grad student at UC Davis. So I want to start with this concept. I'm going to start with a few facts, but the key point is that in the last 35 years, rich countries, OECD countries, and Europe among them have experienced a very important change in how population grows. There has been a very sharp decline in the growth of native population, and at the same, so that growth of adult population has gone from positive to negative in the average OECD country. And total population, though, has not declined as much because there has been a corresponding substantial increase in immigration. And as I will show you, large part of this immigration into OECD countries, so into relatively rich countries, come from relatively less rich countries, non-OECD, Eastern Europe, Asia, Africa, and Latin America. And the question is, did this change in the way population has grown has affected growth and productivity? So first I'm going to show you some key facts, some feature of these changes in population growth through immigration. Then I'm going to ask what drives the variation across countries in immigration rate, how some OECD countries grew more than others in terms of immigration. And then I'm going to look at how this impacted macroeconomic variable. In particular, I will focus on GDP per capita, then GDP per worker, which is labor productivity. And in labor productivity, I will decompose this into what part come from investment, total factor productivity, and human capital. I will also say something about the impact of immigration on prices from what we know, but you will see that those are a little bit noisy results, and I don't want to say too much about that. So the new part of this study is that we add some high-quality data, which come mostly from census estimate, of how OECD countries have been affected by immigration. And the variable that we look at is net immigration, how the number of foreign-born in a country has changed over 5-year periods. So we're going to take a medium to long-run look, and we're going to combine this data with macro aggregate, and we're going to use an identification that allows us to look at medium to long-run effects, although, as I will tell you, you need to be very, very careful in interpreting this causally, but certainly we're going to try to put together evidence that suggests strongly some connection between immigration. And then we're going to go back and we're going to say, does this macro evidence that we show connect and is consistent with the lot of micro evidence that we have had in the last 20 years, to which, on which I have contributed in part? That's where a lot of my work is. And what do explain a little bit these results? So the country sample that I will show you are all the OECD countries, so all the countries, essentially the rich democracies of the world. But also in the paper we focus more on EU14 plus, which is EU14 plus UK, Canada, US, Australia, and New Zealand, which are essentially the rich economy of Western and Northern Europe, which attracted most immigrants, and the other countries in the world which have institutions relatively similar to Europe, because this is a little bit more of an homogeneous sample with a big spanning most of the immigration rates. We're going to look at 5 years variation or changes of immigration, and we're going to look at economic outcome from the Penn World Table. The two main variables that we're going to consider as explanatory are the change in immigrants from non-OECD countries. I will say something more about this over 5 years, standardized by the adult population, which is constructed as the difference in stock. So these are immigrants that come and stay in a country. The net come from the fact that we think that these net changes capture how the labor force and how the population has changed. And then we're also going to compare this to the change in native population, which is the native population in working age, also standardized by population. So these two are comparable. A 1.01 change in each is a 1% growth of population, either due to immigration or due to native worker. So the first data that I want to point out is this table, in which you see how the immigrant, this is the percentage growth of population due to immigrant in the 90s and in the 2020-2024. As you see, this rate was 1.5% every 5 years in the 90s, and it grew to about 4%. So immigration as a percentage of the population in terms of rate almost quadrupled. At the same time, the native population, who was growing, the total population at the same rate as immigration early on, has become negative, and this has attenuated the change of the total population from 3 to 2. So immigration in aggregate in the OECD country has offset this factor. However, a very important point that, again, I want you to appreciate is that the growth of, this is the share of population which is made up of immigrants in all OECD, in the EU14 and EU14 plus. The growth of immigrants as a share of population comes in the large part, and I would say almost completely, from the growth of immigrants from non-OECD countries. So people coming from the less rich part of the world. And if you see, not only EU follows this, and in fact EU has had a bigger growth than average OECD, but the large country of EU, like Germany, like Spain, like Italy, have in particular been immigration driven by non-OECD. They come from non-OECD, but one very important thing is that immigrants on average are quite educated relative to natives. This is a chart that shows you the ratio of college to non-college educated of the net inflow of immigrants in each country by 5-year period, compared to the ratio of college to non-college educated in the receiving resident population. Above the 45-degree lines means that immigrants are more college-intensive than natives. Below means that they are less. 81% of the observation have immigrants more college-educated. And these points here have been cut because in some countries they are massively more educated. And even in the country where immigrants are a little less educated, they are close to the 45-degree. So it's an inflow from OECD, from non-OECD, but it's an inflow of people who have a high college education rate. I know already some of you think these are people who come as doctors and then they are taxi drivers. I'll get back to that later on. But keep in mind that this human capital content is going to be extremely important. The last fact that I want to show you is that although on average I've shown you that as in the OECD countries there was a decline in population growth was accompanied by a growth in immigration, it's not true that, in a sense, immigration is replacing native at a country by period level. This is a scatter plot of, on the horizontal axis, the growth of the population due to the native change, and the vertical is due to immigration. If there was, say, a one-to-one for each native that is not, that we don't have, you have an immigrant, this will have a minus 45-degree slope, while essentially there is zero correlation. It's not true that countries that are shrinking faster are the countries that attract more immigration. There is a lot of variety, and these two variables are almost independent. So that's one of the reasons why we can also analyze them at the same time. The red dots are Europe, and you see that a lot of the countries in Europe are in the negative part of the demographic growth, and some have very low immigration and others have very high immigration. Now, when you start thinking about what has driven the variety of immigration rate across countries, then we went to what are the classic determinants of immigration in the literature. So in large part, literature says that the fact that immigration has grown in many countries in the world, in many non-OECD countries, interacted with the network of immigrants, because immigrants from some origin country tend to go more in some than in other, could explain the variation across countries. What we find, though, is that at the national level, this kind of push factor plus variation in terms of network does not explain a lot of the changes in immigration rate that what we want. Of course, it explains the level of immigration rates across, but there is not enough variation, I would say, in the aggregate flow from different parts of the world. Migration is grown almost steadily from all these countries. This method then doesn't give us a lot of power to explain migration. We also focus on this method just for some crisis countries, which have genuinely changed their migration patterns. But again, although people talk a lot about this crisis, about Syria, about Venezuela, in a total of 100 million migrants in this period that have moved to OECD country, less than 10 million has been explained by this crisis. So even these crises are not very powerful in explaining what goes on. Then we move to a little bit looking if immigration policies of the receiving country explain this, and we build on the work of this group of scholars, which are legal scholars that constructed this immigration in comparison, IMPIC index, that try to capture how tight or how loose are immigration policies. And we focus on these two policies. One, which is how a country regulates who can come in the inside, based on family, work, and refugees claim. And this is an index 0-1. 1 is the more open type of policy, and 0 is the less. And then other is more about enforcing the border, how much people consider undocumented as criminal, how much they have a network that stop immigrants. And we will see how much they explain of immigration. However, you will see that once you have looked at this factor, there is still a lot of immigration which is really not explained. And so we try to isolate as an alternative, what did I do? We try to explain as an alternative those cases of immigration in which there seems to be sudden surges, which means a country didn't have immigration at some point as a sustained jump up, and a sudden shock, a low probability event that brings a lot of immigrants that are not explained by this other variable. And we also look at how countries respond, not just to this more systematic immigration, but this more random immigration. Now, this is a graph, and you don't need to look at all. That shows you how the power of this factor to explain. As you see, what is shift share and crisis shift share is how much this push-driven and network explain, and there is not much that they explain. These are non-significant coefficients. Instead, in terms of policy, the one which is more consistently and larger is the external regulation. The external regulation is how you regulate essentially your legal immigration, and 0.11 is a big number. Going from the least to the most restrictive, you increase immigration flow by 11% per year, which is large. But then the factors that really are more correlated with immigration are these more random shocks or more random surges, which are associated to larger immigration by 1 or 2%. So with this in the background, we estimate the impact of the change of immigration and change in native working age in a panel which has a country fixed effect and a time fixed effect, using the local projection method that look at different horizons. We're going to look at 5 and 10 years ahead, because in a panel of 35 years, that's the best we can do. And as outcome, as I will show you, we will look at a series of a series of outcome. And first we do just an OLS exercise to have a benchmark. And then we split between high skill and low skill immigration. And then we'll try to get a little closer to a causal identification. The output that we will look at are these 8, but we will focus in most of the analysis in worker productivity and the component, what comes from human capital intensification, total factor productivity and capital per worker. Of course, we want to check that immigration also has an impact in increasing the population, because more immigrants, they don't push out natives as a consequence. And we're going to also look at the effect on price index. This is the composition that macroeconomists know, that GDP per worker comes from growth in total factor productivity, growth in capital intensification, and growth in human capital. So these are the impulse response at 5 and 10 years of the predictive power of a 1% of extra immigration. Extra immigration is the blue, extra local population change is the orange. Notice the first column. Population growth, this is a 1% growth. Both increase population permanently, because more immigrant or more people means a 1% increase of immigrants generates roughly a 1% increase in the population. However, they have a very different effect in GDP per worker. In fact, the natural growth of population is essentially a very flat profile, while an increase by 1% of immigration has a positive and significant. Of course, if you test, there is an overlap, but it's clear that GDP effect per worker of immigrant is significantly larger here. And if you look at the effect on employment-population ratio, you don't find much, although you have a little attenuation of this because of this employment population on the GDP per worker. But if you decompose this into what is due to human capital change, total factor productivity, and more investment, you find that in all cases, immigration seems to stimulate more human capital, more TFP. Remember, immigrants are more on average educated. But where you find the big effect is they stimulate investment quite significantly. This is the effect on prices. As you see, is massively imprecise, and it's a little bit bouncing around. So on average, this is not inconsistent with immigrants not systematically affecting price level in the long run, as if they have real effect, that makes sense. But I'm not going to pick up on that anymore. Now I want to decompose what is the impact of high-skilled, the pink, and low-skilled immigration in 5-year and 10-year. And here you notice that while the impact overall of low-skilled immigration of labor productivity is roughly 0, high-skilled tend to increase productivity, and they tend to increase it mechanically because they are more educated, so they generate human capital, but also because they increase the efficiency and they increase the investment of an economy in capital per worker. And I will tell you what we think are the channels. Low-skilled immigration has an overall relatively 0 effect. Mechanically, of course, if you admit a low-skilled immigrant, you're going to have a less educated population. But this is a little bit offset by the fact that there are investments that respond, and there is some TFP response. So on average, the low-skilled immigrants don't have an impact on productivity, or don't have a significant impact on productivity. Now let me show you what is the effect instead. Here I've looked at just the OLS. Now take a policy change and take a change of a policy in the direction of loosening immigration. Now this is the response to a policy change that is adopted by the country. And you see that the policy change has a similar effect that the one they estimated before. When the country go from tighter to looser, there is an increase almost significant at 1% at significant at 10% of GDP per worker. worker, and the strong impact of it come from increasing investment, although TFP and human capital also are upward sloping. What is the response to a shock or to a surge? And again, some people, shock and surges mean immigration larger than the median over 5 years. And even in this case, although the effects are a little attenuated, and in this case are significantly attenuated, maybe because the inflow, the kind of sudden inflow takes a little bit more time to respond, still you have a positive effect on GDP per worker or a neutral effect on the other variable, and always the variable that responds more significantly in the long run is the increase in capital per worker. This is trying to test of the nonlinearity of this response, splitting immigration between high rate and low rate of immigration above the median. The high rate are the red and the low rate. So does a country have an easier time in translating immigration into productivity when there are low immigration rate rather than higher, when immigrants come a little bit more gradually? And there is a little evidence, the blue effect is the low and the red is high, that there is, but there is a lot of imprecision in estimating this. And this is instead if you start from a low or a high immigration share, below 10% or above 10%, and here we don't see much difference, which means that there is not a significant decline in the positive effect of productivity of immigrants in the range of immigration rates that we observe. We also do a regional analysis on region in Europe to apply a different strategy, and I'm only going to say that in terms of qualitative terms, the GDP per worker effect, and driven in large part by capital per worker, is confirmed at the regional level. And to summarize, and then I want to say connect with the micro, it seems that net immigration, more open immigration policy, shock immigration is all driving or connected or predicting a higher GDP per worker. High-skilled immigration seems to drive not only an increase in human capital, but more efficiency and more productivity. But low-skilled immigration does not hurt productivity and does not hurt efficiency. It just generates a neutral effect on labor productivity. All this point in the same direction. Now, let me say what are we think the channel. First of all, there is an existing macro evidence, very little, that there is a study by the IMF, and I worked on this cross-country analysis that aligns with this positive productivity effect. But they take a much shorter term. They most look at what happens after 4 or 5 years. We look at what happens over 10 years. Second, there is a massive literature that says that skilled immigration, because they focus on science, technology, engineering, and math, they are producing more patents, more innovation, and they may have a very strong productivity spillover on natives. Why are the strongest effect over 10 years? Because it takes a little while for immigrants, even high skill, to fully integrate and produce their effect. Also, native, in response to the inflow of immigrants, change a bit their specialization in an efficient way, and this also takes time. This is the factor on which I've been working more in the last year, which is matched with what we have. Immigrants are at a much higher rate entrepreneur, firm creator, and investors. And this can show and can justify the effect on capital per worker. We are looking at master students, foreign master students, and foreign college students all over the world with this Revelio data in a paper that I have with Michelle Bain. And we see that they are very important innovator in firms. And finally, the fact that we see a small to zero effect on labor productivity of low-skilled immigration is kind of consistent, although wages is not labor productivity. There are many margins, and people are worried that some margins are affected by immigrants. But this is consistent with the idea that low-skilled does not hurt labor productivity, and high-skilled help. Let me leave you in the last 30 seconds with a couple of numbers. Of course, these again, be very careful to take them as causal, because they are not. But if you take the coefficient of the predicting power of immigration, and you look at what productivity effect this immigrant will have over the 34 years that we are analyzing, a country like Spain, which had a massive inflow of immigrants, 28% productivity growth in this period could be explained by immigrants. Spain had roughly a 74% productivity growth over these 4 years, and 19% in the UK, 14.5%. Of course, these are only order of magnitude to say how important this effect could be and how we'll need to continue to understand country by country, but in aggregate can be very important. So the conclusion that I want to leave you with is the idea that immigrants, yes, they have replaced the native worker by replacing population and adult population growth, but there could be much more in their effect going through this support of investment, entrepreneurship, and for high-skilled support of idea, support to TFP, and that go not just in replacing GDP, but in helping GDP per capita.
Excellent. Okay. Thank you very much. Excellent. Hello.
Hello. Thank you for the opportunity to present and discuss this paper. So I will have two sets of comments, some on what is in the paper report and some on what is not in it, and I think should be, if not completely integrated into the quantitative framework, at least should be discussed. Okay, so just a very brief summary first of the paper. I see there are three contributions. One is a new data set for this period of the last 35 years of net immigration inflows to the OECD. And it is disaggregated by origin country, skill level, to skill level, below, above college. It shows essentially two major trends, which are not known to the general public. One is the rise in the skill content. I mean, there are more and more skilled immigrants, and according to the data shown, the immigrants are on average more, the skill ratio is higher than among the native population in most countries. And the second is the shift in the origin mix, with more and more non-OECD origins in the migration to the OECD and less intra-OECD migration. Then there is a try to do some empirical analysis of the determinants of those migration flows. It's not so conclusive. And then an empirical assessment of the generally positive contributions of immigration to growth in OECD countries in the last 35 years. And these contributions shows no saturation. There may be diminishing returns, but still in the observed range, we still get something quite positive. And there are different markers, different metrics of this economic performance, income per capita, of, productivity, and so on. And the results are driven mostly by high-skill immigration in the medium run, so with enough time for these effects to kick in, and they are robust to conducing the analysis also at the regional level, which allows for slightly improved identification. So overall, I think it's a very useful, well-written paper. It gives an important baseline framework to frame future policy discussions on immigration in the EU and beyond. So as I said, two sets of comments. First on what in the paper, and I would like to see some robustness to certain things, and then discussions of channels, through which I think are important, but not dealt with in the paper. So my first set of comments is on the data and the samples. Question, and I asked Giovanni already, is why net immigration flows, rather than looking at inflows and outflows? Because inflows and outflows do not necessarily affect the outcomes in a symmetric way. That's the first thing. The second is that you can get the same change with very different changes in inflows and outflow. For example, a zero change could come from a big change in the inflows and equal change in the outflows, or from just no change. All right, so I want to see really what are the margins which are important. And so I think we're losing here important information and insights for policy by looking at net, at the net. At least you could do also inflows and outflows and see this kind of decomposition. The second is, it would be interesting to know whether the rise in the skill content comes from a rise in educational attainments of origin countries for a given origin mix, or whether over time we've seen a change in the origin mix towards countries with higher educational attainments, for example, Asian countries being more represented than other countries with lower human capital levels. And this has been done, for example, in a recent paper for the US by Madeline Zavodny and a co-author. And then on the sample, you look at OECD as a destination, non-OECD as an origin, and you also focus on the EU plus, so EU plus Northern America, Australia, New Zealand, by taking out some OECD countries like Mexico, Turkey, Eastern Europe, but you don't put them into the origins. And I think by doing this, you're missing very important migration corridors, the main one being Mexico, US, but you know, Poland, Germany, Turkey, Germany, and so on. So that's an easy fix, and I'm sure you had in mind to correct that, but I think this is really a must. On identification, I'll be short. First, because it's a bit technical and boring, but also because you are very transparent and open that you don't making strong causal claim, and rather, and I think this is absolutely the right attitude, because in cross-country exercises, there's always challenge. Identification is really challenging, that your conclusions rest on the convergence of descriptive and imperfectly identified exercises, and this is where you get confidence in what you say. On the Jorda's local projection approach, I know there are recent extensions which integrate the IV procedures, so I was wondering whether you tried them or plan to try them. And maybe just on the destination shocks, if you recall, some 10 years ago, I was part of a team trying to produce these measures of immigration policy, and we were kind of competing with the IMPIC project. So I have a bit of a regret that we didn't push this. We run out of fuel, that is of money. But now with AI, machine learning, LLMs, I think there's really great opportunity to do this kind of analysis of analyzing, legal text on immigration and so on. So, so now I'm turning to the things that are not in the report and I'd like to see at least discussed. One is a missing benefit, which I think is the role of migration in globalization. You write that migrants are not just workers, they are also entrepreneurs and innovators. They affect firm creation and innovation, and I would add that there are also bridges that make connections between countries, and they reduce informational frictions, and along those bridges, many more things can circulate and travel. So they promote trade, they promote FDI, they promote other types of investment flows, and I think this is an important component because this is affecting the export performance of countries, for example, grant them access to new markets through either exports or FDI, contribute to diversifying portfolio assets and reduce home bias. I think all these things are part of the macro impacts of migration. And there is a literature that you know about. The second is that you look at migration productivity, you discuss some channels, but there are other channels which I think are important. And the first one is workers' diversity in itself. Diversity can have productive effects because migrants bring a set of skills, knowledge, and know-how that complement those of native workers. And that can contribute to better matching. You've worked on that, Giovanni, between workers and job, and you have this complementarity in skills effect. And there is also here a few references according to of your papers, which I'm sure this would be the easiest part to integrate to your framework. Then there is also knowledge diffusion. We know that migrants come with them, with knowledge embedded in them, that knowledge carries knowledge from their home country, and through this, they can shape the comparative advantage of nations. There are many historical examples. The Huguenots moving from France to Germany and contributing to start industrialization in Germany. The Jewish scientists who fled Nazi Germany went to the US and contributed in different fields. And there is a recent literature which I contributed to, mostly with Dani Bahar, my co-author on this, showing that this is more than something anecdotal for some examples, but there's a general phenomena here of this knowledge diffusion. So let me, to conclude, speak to a cost that is not touched upon in your paper, but was that's what Boris Vujčić mentioned, is that there may be economic benefits, but there are political costs. And as economists, we want to balance them. And we know that there is this discussion on the contribution of migration to the rise of right-wing populism in different places, including in Europe. So we may say, well, this is a political judgment, but as economists, we know there is a cost of these measures, and I don't know if Moritz is in the room, but he contributed this great AR paper with Funker and Trebesch trying to measure the cost of populism, and it was very significant. So what we know is that this is mostly driven by low-skill migration and not so much by high-skill migration. In a recent paper with Frédéric Dauquier and co-authors called Populism, the Skill Content of Globalization, we show actually that, you know, high-skill and low-skill migration, same for trade, have opposite effects on support for a right-wing populist party. And so, on the other hand, right-wing populism, anti-immigration attitudes have resulted in adverse selection into immigration. So they are more repulsive, although the target is low-skill migrants, they are more repulsive to high-skill migrants who have a choice where to go and for whose preferences are to live in a more open, inclusive, liberal environment. So this is generating a vicious circle that we call the vicious circle of xenophobia. We published this last year in Economic Policy, so the CPR journal, showing that you have these dynamics leading to, you know, potentially bad equilibrium where you have high levels of right-wing populism and low levels or bad skill ratio in immigration. Okay, so I think this should be part of the discussion because this is very much in the heads of the policymakers. So to conclude, I have a few minor points I won't detail. I think it's a very useful framework because you integrate most, if not all, the channels through which migration affects labor markets, productivity, and growth, and that can serve as a reference framework for policymakers. It's useful also because it goes against some received wisdom which is incorrect. There are missing dimensions that are hard to integrate but should be at least discussed. And then you don't make, last thing is that you don't make policy recommendation because you're a careful person. But I think you need to take a stand. So I guess you will get questions. I'm anticipating a bit. Should we increase inflows or reduce outflows? Should we be more selective or diversify the set of origins to get at what the type of migration we want? How can we think about migration as part of a growth strategy for Europe in a fragmented world? I think that's typically what a policymaker will ask. Thank you.
Thank you very much, Hillel. And with that, I mean, there are already some questions for Giovanni. So
yeah,
you want to touch on a few. Some of those before we open the floor.
Yes, I'm going to touch on a few. Granted that some of these points that you raised make perfect sense. So one is the gross versus net flows. So one problem of the gross flows is that the source of those data is very different from the source of net flows. Net flows can be calculated as census, in which you have stock to stock. Gross flows come from aggregation of information of crossing the border, administrative. And very often, the census to census include many more categories, right? The undocumented are captured in the census to census. The official gross flows year to year don't capture them so much. Think about, though, in my specific case, I'm also looking at immigrants from non-OECD into OECD countries. So the gross that you will be are immigrants that go from non-OECD into OECD, and then they return into non-OECD, which is maybe not as big of an issue as if you were looking at internal flows. But we'll keep it in mind. We'll certainly discuss it. Mexico and Turkey among the sending country is an important thing. One thing on the raise of skills, immigrants have been skilled throughout the period that we look and a little bit more, but the origins, there is a graph in the paper that shows that the region of origin in aggregate has changed relatively proportionally. That's why also the shift share doesn't work. So I would say that a lot of both what has happened with immigrant in skill and their effect come from two sources, I think. Not so much from the change in the country of origin, although there has been a shift. Immigration has grown from Asia, from Latin America, from Africa, but from selection of immigrants. This is a selected bunch, and that's why a lot of college-educated arrive rather than a more balanced composition, and integration of these immigrants. Those, I think, into the economy. So these, I think, that are the two crucial things that are going to be that we need to think about when we think about policy. These people who come to OECD countries are significantly selected, not just on education. They are entrepreneurial. They are willing to take risk, and so on. The political cost of immigration, I'm going to say something on this and then on trade and diversity. The political cost of immigration are very clear to me, and I also have some paper that show that high-skilled are much less consequential in this backlash than low-skilled. And so, in a way, if you want a recommendation that comes from this type of analysis plus the political analysis is that, number one, an inflow of immigrant that balances the decline of population and is balanced between college and non-college. Balance means 50-50, which is much larger than the share of college educated in the population, will be more easier to sustain in popularity, replace the population of Europe, and a boost to productivity because 50% of college is very large. So whenever we do policy and we allow more foreign students in college, more foreign master students in college, more foreign skilled, that allows us also to increase a little bit the workers that we can admit. I think that a balanced policy that offset the decline in population is a policy that allows the size of the GDP of the US, of Europe, the productivity of Europe to grow, and maybe doesn't generate that cycle. Yes, I agree with you, and I have done a lot of also other work on immigration as a connector, bridges. This is very important, trade, knowledge diffusion. In this super simple framework, and we will discuss, I think some of this effect of immigrant in promoting trade and in promoting knowledge transfer, as long as this improves the productivity of a country, will show up there, and so we can discuss them and talk about them in that area. And certainly one can also look at the aggregate openness of a country as a result of immigration. And maybe we will say something a little bit more articulate. But all in all, thank you very much, Hillel, for all these thoughts. Of course, this is not going to be the last paper on this very important issue. I just wanted, after having worked for 20 years on a lot of micro-analysis, country-specific, I wanted to put up a framework that allows us to talk about OECD country all together and have some reference numbers that people can criticize, revise, improve, but at least we know what magnitudes we're talking about, and I think that's the important part of this paper.
Thank you. Now let's open the floor for the Richard. Let's start from there. Richard Alvaro Horde.
Thank you. Richard Portis, London Business School, and from the UK, a major host country for immigrants. And so I miss a little bit here discussion of the demand side, the need for care workers, for hospitality sector workers, and so forth, low-skilled, effectively, people, but our policies are in a sense supposedly discouraging that. We have a minimum wage policy for visas, and it's not clear yet how much effect this has had on the skill composition, but there are certainly major shortages in those low-skilled sectors. And the second point is, again, in a sense on the demand side, the absorption of big immigration flows. We've had real huge swings in the numbers in the UK, and some of that has to be due to the difficulties that we experience in absorbing the inflows of workers. Pressures on social services, pressures on housing, not just the sort of political impact of all this, but the actual real difficulties in absorbing big flows of people. And whatever the benefits, and I'm strongly positive on immigration. Obviously, I'm an immigrant, right? As you are, Giovanni. But still, this is a big issue.
Yeah, here.
Yes, just a very quick comment on the last slide where you show some cumulative productivity growth numbers for 3 countries. The number for Spain just can't be right. 74% increase cumulative productivity growth from 1994 cannot be right. I have in front of me an OECD report on the productivity problem in Spain. Productivity growth has been systematically lower than in the OECD countries, and the cumulative growth has not been above 25% over this period. Maybe you're reporting cumulative GDP growth.
Cumulatively, GDP per worker growth from World Bank report 2024, calculated as average per year, 1.7 growth per year over the period. Of course, with up and downs.
I question.
Okay, you question the source, the World Bank.
No, I'm not questioning the source. I'm questioning that the numbers have been drawn correctly. I have here the OECD, 1% on average in the 90s, 1% in the 2000s, 0.5% per year in the 2010s. You add this up, it's 25%.
Per worker, though, GDP
Yes.
per worker.
GDP per worker.
Okay, that's different from the World Bank.
Very quickly, first of all, OECD countries are very different from each other, both in terms of immigration, attitudes, and many other issues. You know, one thing is Korea with very low fertility rates, or Japan, and then you have the United States, Australia, Canada. So I think that's important to put this in perspective. Second, the numbers of the fertility decline are such that even with very large immigration flows will not be enough to sustain the decline in population. So immigration is part of the equation, I have no doubt about it. I think I'm also was an immigrant for many years, and I strongly agree with that. But I think it's important to put, and the OECD says that very clearly, the old age dependency ratio is rising so strongly that will not be enough, the rise of immigration to counteract this increase in the rise in the old dependency ratio. And important to say, immigration is part of the picture. Longevity policies also have to be part of the picture. That is, the way that we are not only increasing retirement ages, but encouraging for people to stay longer in the labor market if they want to, because many countries don't allow it. And I think this is important. And there's an OECD study that shows exactly that, for example, Spain, GDP per capita could decline by 20% without longevity policies. With longevity policy, will be a lot lower. Finally, migrants as entrepreneurs. Totally agree. I think we've seen that in several countries. But again, it depends on the country. So in Japan, the type of immigrants they're getting, it's not exactly the type of immigrants they get in the United States. It's true that S&P 500, you have a lot of CEOs that are from previous immigrant backgrounds, but in many OECD countries, this is not the case. Thank you.
Thank you. So, yeah, more is late, but...
Let me answer some, otherwise I forget.
Yeah. First 3, and then we go 3 by 3. There's an excess demand for this discussion.
I know. It's always the case, immigration. Yeah. Okay, let me go in reverse order because the last question. So, you mentioned the case of Japan. Japan is a case in my range that has it pays the cost of very low immigration. So, you're right that entrepreneurs in Japan do much less, but immigrants in Japan are much fewer. And so, that's kind of in the negative part. We have a study that looks at immigrants all over the world, and in every of the countries that attract a significant share of students, master student and college student, immigrants are always more entrepreneurial than native. So, right, it's not in every single country, but it's a very prominent feature of immigrants in a lot of OECD countries to be highly productive. You say that we cannot compensate fully the projection of decline in population with immigration. Maybe, but that's maybe because we don't have enough creativity. So let me give you the 5-year number. In the next 5 years, the population of Europe, the labor force, the adult population of Europe is projected to decline by 3%. 3% of 300 million is 9 million net, and I think we can easily absorb 9 million net immigrants in the next 5 years. Of course, if the the rate of fertility continue to decline, maybe we won't, but I think in the next 5 years, this can be part of the discussion to offset a lot of that decline. In terms of the productivity growth, here I am calculating for all these 3 countries that I showed you this data from World Bank report and from the World Bank data set that has a GDP per worker per year, and Spain was more in the order of 1.5, 1.6% growth per year in the fast period, and then in the recent period more 0.8. But I take the point, we can look at another data set. Richard, yes, so this is a view of immigration from a little bit a big level. I wanted to aggregate what we know how to aggregate in macro. A lot of the effect of immigration are sector-specific, region-specific. The aging part of the population, I think that part of the help of immigration, and people have written, and I have written about this, is not just that it will compensate the population growth, but it's that a lot of immigrants are employed in the part of the economy that support the elderly in a massive way. We are needing this assistant, home assistant, healthcare assistant. And as a consequence of this, the fact that we have more investment when immigrants come, also I think in model in which you have a bottleneck because you don't have the right abilities in the local people, and when they arrive you can invest more in those sectors because you can expand production there, also come from this sector misallocation in part that we have in a rich country where very few people will want to work as helper of the elderly, but we need that part. Some of the crowding effect and some of the impact on price of housing is better looked at the local level, at the regional level, you are right. In aggregate, we wanted to say if these impacts are big enough to show up in a price index that includes the price of housing, and we didn't find it, but I agree with you, in some location this price of housing is big, but if you think about in any city where you have more people and don't build more houses, the price of houses is going to go up. So it's also a housing policy type of approach rather than just an immigration approach, and as such we should think about it.
Thank you. Moritz? And Vito, Fabio.
Yeah, thank you. Moritz Ulrich, Kiel Institute and Sciences Po. Thanks for the great session. It was really a great pleasure. I wanted to come back to the big paradox that Hilal mentioned. If immigration is so beneficial, why is it so unpopular? And so what you do is you look at aggregate outcomes, and some of the answer to that question might be in the distributional side. So suggestion is, can you look at income growth across the distribution and maybe get a sense for why that backlash and that populist backlash is happening. Second suggestion, coming back to what we said yesterday in the AI discussion, a lot of the effects must just be heterogeneous in the sense that labor market institutions, social security provision, healthcare systems, all of these must matter tremendously for the effects that immigration has on the receiving countries. Is there any way you could tease these effects out, and what do you think about that? Thanks.
Peter?
Thank you. Very important topic. But unfortunately, one of the merits of the paper is that it is very transparent in what regards the sort of weak causality that it can really show us. And that should not, I think, be ignored. Hillel drew attention to that, but then didn't dwell on the point. But indeed, you have local projections, you control for country fixed effects, time fixed effects, but you cannot find, especially at country level, a real strong exogenous instrument to try to prove causality. Despite your efforts to do so. So I think that the importance of the paper, nevertheless, is that the evidence that you find and the conditional co-movement that in any case is proved, it's enough to dispel the more conventional view anti-immigration that immigration would necessarily reduce capital per worker and therefore productivity, also because the educational composition of immigration, the prior of those conventional views is that it is quite below the level of the host countries. My second point is a question. You find by using a aggregate index that open external policies contribute to the flows and therefore to the effects that you find, and even without excluding reverse causation, that immigration goes to countries that have good expected growth and perhaps a starting investment boom, which then attracts immigration. You cannot disprove that, but nevertheless, the association is strong enough. And in terms of policies, on which you don't enter too much, what would be the important points of this open external policy? Thank you.
Yeah.
Dirk Nieper, New Bern. You emphasized the investment boom and capital deepening. So can you say anything about consumption in per capita terms? Has this increased significantly? And coming back to your discussion with Richard, I guess it's important to distinguish between tradable and non-tradable sectors. I was under the impression that trade should be to some extent a substitute for migration, but your data seems to maybe suggest the opposite. Can you say anything on that? Thank you.
Okay, 3 is a good number, and then I can. Okay, so all very good point. Inequality. I mean, the first point is the inequality of the effect, and obviously here I'm doing an average, and I agree with you. A lot of the contention is in the inequality effect that immigration has. We have several papers that look at how important is the fiscal redistribution on top of this effect. This tells you that essentially immigrants create a surplus in a country that is significant, important through investment and through TFP. And this, of course, probably is redistributed in a way that depends on the fiscal system and on others. So in this aggregate data, to find income distribution data of all the country in a consistent way is a little bit more complicated. And, estimating with the 350 observation effect on a distribution, it's a little bit harder. But I would say that I agree with you. This just say that in aggregate there is going to be this surplus, which is very important, and is not. There is no evidence of a crowding effect in the medium to long run, and there is an effect of increasing the size of the pie, and the distribution of this pie is fundamental to see who gains and who loses, and it depends on institution of the countries. So in answering, thank you for the observation about this is not causal, but there is a lot of convergence of interesting points. So actually I do, in reply to, we do a shift share IV at the regional level with these local projections, and the results go in the same direction. And the policy result that you say is in using the policy sort of as a reduced form IV, in which you are going to look at the effect. We can, I think, dispel the worst version that says immigrants is associated with lower crowding, lower wages in this. What are policy, openness policy that seem to be recommended? Again, I go back to the idea that policies that allow an inflow of immigrants which is balanced between college and non-college, but also as non-college, because we need those people. So we should increase both, I would say, not because we don't have enough high-skilled, then we cut completely the low-skilled. I think the direction should be to make a little bit a planned immigration policy across countries, and low-skilled are as important as high-skilled in some sector, and we should try to address that. On consumption, we don't look at consumption, so I'm not sure. But on the substitutability between trade and immigration, that should come straight out of an ex-Sherolin model, there are mountain of evidence that's not the case. Immigration is complementary to trade, because if you have a model in which trade friction and information friction are important, immigration breaks and loosens this information friction, and so trade and FDI and technology transfer seems to be helped. So it's more than a comparative advantage story. Here is a story of trade cost through friction that immigration seems to reduce. And so I think that these results and other results are consistent with this complementarity between trade and immigration.
Thank you. There's a huge excess demand for questions, so I can only pick up 2 more. Sorry, because we passed the time, and then I will ask both of you then to address. You can address any of the previous ones. So Fabio and Yanis.
Well, thank you for a fascinating presentation and discussion. Giovanni, you analyzed the effect of migration on the country of destination. I was wondering whether you have looked at the effect on the country of origin. Skilled migration benefits the country of destination, but one might expect that the opposite effect could emerge for the country of origin. And analyzing the impact on the country of origin would be useful to understand the effect of migration on growth at the global level. Is it adding to global growth, or is it just shifting growth from the countries of origin to the countries of destination? Second comment is on a question, comment, whatever you. One topic that is often discussed, especially in destination countries, is the difference between regular versus irregular migration. So I don't know if you have numbers, information on this, but this difference between regular and irregular migration is often raised for populist reasons. But there could be economic rationale, because one might hypothesize that regular migrants could integrate much more easily in the country of destination, while the opposite would be true for irregular migrants. So regular migrants might add more to entrepreneurial activities. They might induce more investment. So there could be a difference. Did you look at this? Do you have the information? It would be nice to look at this analysis. Thank you.
And the last question.
Thank you. Thank you for an excellent paper and discussion, which is at the heart of economic and social policy these days, and also for a positive, optimistic, and, if I can say, cosmopolitan message. I have three questions. The first one, it's on causality. Many other colleagues have raised the issue. I understand how, if immigrants are more skilled than domestic populations, how labor productivity has grown, but I don't understand how capital per worker has increased. What is the causality here? Second, have you looked at macroeconomic imbalance? What are the effect on inflation, fiscal, social, current account? For instance, in Greece, during the convergence period, without the Albanian workers, who wouldn't be able to achieve the convergence criterion, the inflation convergence criterion. I'm sure about that. And my third question, yesterday we discussed a lot about the AI. Have you thought how AI will affect the flows, the immigration flows? Thank you.
Thank you.
Okay, yes. I'm going to answer, and then I'm going to leave it to Ilan to develop. So, country of origin. This is the other part of the side. So, I think the traditional economic approach is that immigration is very good for the immigrant, and I think there is a lot of evidence that is good for the destination country. For the sending country, in a sense, sometimes this is called brain drain, in fact, and by the definition can be negative. There is evidence that if the immigrant don't live forever and then at some point return, if the immigrant send remittances, if the immigrant send technology, this can also help the country of origin. So an exercise like this done on the country of origin, I think it will be interesting, and I think it should be the next step that we can do, and we can look at this. Regular versus irregular. So interesting, it's a little harder to separate. In most of my data, they're both. And I would say one thing. It is absolutely true that there is a difference in impact of regular versus irregular, because being irregular reduces the integration of immigrants, it reduces their wage. There seems to be a significant difference in this between Europe and the US. In the US, in spite of all the talk, until very recently, undocumented immigrants integrated very promptly and very fast in the employment market. They found job. The labor market was more forgiving. There was this. In Europe, they have been left at the margin, and as anybody left at the margin, all the productive effect that you have are going to be much smaller if you have this. So definitely the idea that we should go towards more regular immigration. By the way, in Europe, a lot of policy has been done by admitting irregular immigrant and then regularizing, and then people have looked at their effect once they are regularized, which normally they find in generally positive. So that's a very important point. Here you need to do a little bit what I'm saying, more country by country, because the institution of the country matter a lot. The capital effect, the capital per worker effect comes from three things. First, immigrants massively are firm creators and they are entrepreneurs. So if you think that the bottleneck is not so much having available financial capital, but having an entrepreneur who has an idea, who's worth attracting financial capital, then more immigrants generating more entrepreneurial possibility, they create this. The second is that these high-skilled immigrant and tech, which are STEM worker in many of these countries, are generating those ideas themselves that generate investment in this country. So an increase in immigrant in STEM attracts. There are this paper that saw when the US increased the H-1B quota, there is more investment in this company from the capital market and all. And then I would say one thing about AI. AI, yes, that's going to be a big thing that changes. We need to think about two things. One, how AI replaces versus complement, interacts with skilled immigrant and unskilled immigrant for some jobs. And I think that AI does a lot of the things that skilled immigrants do sometimes in science, technology. So there may be an impact of AI that is not so different from the impact of immigrant, and we'll need to understand how the labor market absorb this technology and respond on the demand side to understand how skilled immigrant and unskilled immigrant will change. It's an important topic to incorporate. What I'm saying is that we don't know a lot by now, but we'll need to think about it a little bit more carefully.
Thank you, Giovanni. Briefly, Hillel.
Yeah, so I can just complement what Giovanni said on 2 points where I feel I have something meaningful to say on. The first is on Maurice's question. I think it's very important. How come if immigration brings economic benefits, why is it so unpopular? So of course it has to do also with who gets the benefits and who. So it's a bit like for trade. There are some losers. They are concentrated maybe among people who are already more vulnerable socially and so on. So I think that's part of the question, of the answer. The second is a question of perception. When you do surveys and you ask people in virtually any country, what is the share of immigrants in your country, they overestimate by a factor of 2, 3, 4 the share of immigrants. So in France, when you ask people what is the share of immigrants, they say 1/3, 35, 36%, which is 3 times the reality. When you ask them what is the share of Muslim immigrants, of Muslims among immigrants, they say half of them. Sorry, they say 3/4, while it's just 1/2, and so on. So another aspect of perception, and on this I did some study, others did some studies, the perception of the first and the second generation. People perceive the fact that immigrants are, have lower incomes, but they don't see the tremendous intergenerational mobility of immigrants. And for example, in the study on the US, you can see that for a child born in a native household at the 25th percentile of the income distribution, the chance is to reach the 40th percentile. But for immigrants, this is more for all origin countries but 2 out of 100 origin countries. So there is a tremendous overperformance in terms of intergenerational mobility, and this is not something people know about. So there are perceptions, and there are also information and facts to convey about this. The second and the last thing on this is that it's not, the anti-immigration is not just about economic competition. It's about cultural identity and so on. It's obvious, but I think this is largely driven by this. And so immigrants who are more different culturally, more visible culturally in the way they dress, in the way they eat, in the way they pray, are also more conducive to this anti-immigration sentiments. The last point I wanted to make is to answer Fabio's question on the origin countries. I think the point I made on globalization is true in the 2 directions. So those bridges that migrants build are good also for the developing origin countries. It's a way to integrate into the global economy, and it's a much more powerful way for them than for advanced countries of destination. Okay, so let me stop here.
Thank you very much. Great topic, great discussion. I'm sorry for not being able to give floor to all of you. There is a coffee break. You can still come to these 2 great... No, after. Yeah. First I will hand the floor to Piero because he's anxiously waiting with another fascinating topic. So thank you very much.
So good morning to you all, and welcome not to the coffee break, but to the session on tokenization. So tokens and DLT have been around for many years, and they attract the interest of financial people when, almost 20 years ago, Satoshi Nakamoto combined them to propose a new payment system and a digital coin, Bitcoin, for payments in a decentralized and trustless setting. However, for many years, this innovation have remained at the margin of the traditional finance and payments, and we even invented a specific name to avoid contamination. We called it DeFi. Yet contamination has occurred, and through a series of trial and errors, traditional financial and payments operators have been learning how to use DLT and tokens for offer their services at scale in this new environment. In payments, Libra was the turning point. Since then, a series of similar initiatives have been put forward, and today stablecoins are part of the payment landscape. At the same time, commercial banks, money market funds, CSDs have been experimenting ways to tokenize, to use tokenization and DLTs to overcome the traditional friction of market infrastructure, such as limited operating hours and the lack of programmability. Central banks have also been in the game of modernizing the way they offer liquidity to people and markets. Thus, we have witnessed the emergence of a series of uncoordinated and non-interoperable initiatives enabled to scale at the system level. In the face of this risk of fragmentation, many have been thinking on how to make DLT and tokenization truly transformative by providing a blueprint for new market infrastructure where central bank money, commercial bank money in the tokenized form could coexist and provide the settlement asset needed for the tokenized asset to trade efficiently while preserving financial stability. BIS has been at the forefront of this intellectual drive. The BIS idea of unified ledger has gained traction in many jurisdictions, including the euro area. To reflect on this journey and the actual implementation of the unified ledger, we have the privilege of having Governor Yoon Song-shin, who in his capacity of BIS chief economist has been one of the intellectual fathers of the unified ledger concept. In his new capacity of governor of Central Bank of Korea, he is well positioned to present to us today the Hangang project, a concrete application of the unified ledger in Korea. We are equally fortunate to have as a discussant Professor Catherine Casamata. She's professor of finance at the Toulouse School of Economics, and her research spans many fields, such as corporate finance theory, venture capital, corporate finance, fintech, and sustainable finance. So without further ado, let me give the floor to Yoon. Yoon, please, the floor is yours.
Well, thank you, Piero, and thank you, Christine, for putting innovation on the agenda for this very important conference. And as central banks, we're not simply spectators in innovation, and this is a topic where the central bank can really play a very big role in innovation as a driver, and thereby promote growth and stability. So this is very much in that spirit. This is an interim report on some ongoing work based on the unified ledger, and I can get into some of the more details at the right time. But it's worth just reflecting on the history of money and where this project actually fits. Because if we look at history, innovations in the monetary system have always coincided with big leaps in economic activity. And I think the biggest innovation, the most important innovation, was money in the form of book entries maintained by trusted intermediaries. And that really was given concrete form in the form, through the public deposit banks in Europe in the 17th and 18th centuries in particular. And this was the beginning of the idea of settlement. The settlement concept turns out to be really important in the monetary system. And once it's in the book, that transaction is settled. And the institution of settlement really allowed the flowering of trade and commerce through financial instruments that are ultimately settled on the bank's balance sheet. And indeed, these public deposit banks were the precursors of modern central banks. And we still see all of these initial ideas still playing out. The difference, of course, is that now everything is digital. But the architecture is very much the same. And the question is, what is next? And as Piero said, it has to be the next leap in the monetary system, which is how do we incorporate additional features in the monetary system? How do we take settlement one step further? How do we actually make it so that it can actually function in a way to expand the space, the universe of possible economic arrangements? So in the language of economic theory, how do we expand the universe of possible contracts that actually can increase the range of things that we can do? And the central bank is absolutely at the core of it. So don't be put off by the term tokenization. What it means is the monetary system is able to incorporate the contingent performance of actions. You can actually make conditional payments. You can actually make payments conditional on, let's say, someone else's action, as well as a state of the world. And a very simple example would be payment versus delivery. So we have a seller and a buyer, and of course, each side is happy to play their part, provided the other party to the contract fulfills his or her end of that contract. And it's the ability to make credible promises which is made possible by having a payment conditional on delivery and delivery conditional on the payment. So it's that sense of being able to do more things through the contingent performance of actions. So here, I've just drawn this in terms of a flowchart. And the green diamond, as you know, in a flowchart is an if-then statement. If this, then you do that. Otherwise, you do that. And as Piero kindly referred to, one very attractive way of implementing tokenization is to have central bank money right at the center of the platform as the settlement asset. It's the ultimate anchor. But the consumer-facing, the user-facing form of money is going to be in the form of deposits. And they're going to be provided by private sector institutions. And you may have other types of claims on the same platform. And by bringing all of this together, what you can do is to have all of these contingent contracts that can codify all of the promises that the financial system, society at large, can actually perform. And in the 2023 BIS annual economic report, there was a chapter on how we might be able to do this through a so-called unified ledger. It's a ledger because it's in the spirit of the public deposit banks, like the Bank of Amsterdam in the 17th century, but it's unified in that we have not only central bank money as the settlement asset, but also commercial bank money, as well as other types of claims. And what this gives you is our current two-tier monetary system, from, by design. So rather than sending a stable coin, and so if I send a stable coin to someone, the receiver acquires a claim on the issuer. What settlement does, of course, is that when someone sends you money through the bank, you simply see an increase in your deposit balance. And so this picture illustrates that. So here, John is paying Paul. They bank with different banks, and the central bank is in the background. And the payment extinguishes the deposit in the sender's bank, but increases the balance in the receiver's bank. And in the background, there's settlement on the central bank balance sheet. And this is very different from a way that a stable coin would operate. And because all payments are settled in central bank money, the singleness of money is guaranteed by design. Now, of course, another way of doing this would have been to use stable coins and the crypto ecosystem. But I won't spend too much time on that, and maybe we can come back to it during the discussion or during the Q&A. But suffice to say that for the well-known problems to do with the costs of maintaining decentralization, the crypto rails are prone to fragmentation, and that tends to undermine the network effects of money. And because we have viewers from Korea, let me just reiterate what I said at the, during my confirmation hearings, that I support the introduction of a stablecoin framework in Korea. But at the same time, tokenization is best done using central bank money. Now, with that out of the way, let me tell you more about the project. So the project is called Hangang, and it's named after the river Han that flows through Seoul. And you see that, the etymology of all of these things, you'll see there's a very interesting parallel when I get to the ECB project. And Hangang is constructing a unified ledger. We put a different name to it. It's called a digital currency system, but it has central bank money as the settlement asset. We have tokenized deposits. And then, depending on the application, there are different assets on the platform. Now, one question that arises immediately is, how are you going to provide central bank money on the platform? And there are two ways of doing this. One is to link whatever platform that you have with the current real-time gross settlement system, the RTGS system of the central bank. And then make sure that there are triggers that go back and forth so that when there's a transaction on the platform, that triggers a payment, that triggers a settlement on the central bank balance sheet. And that's certainly one way to do it. And indeed, this is very much the way that the ECB is pursuing the first step of its tokenization initiative, which is Project Pontes. And the idea is that this is, of course, the benefit of doing this is that it's much less onerous in terms of a new platform. But you are paying a cost. You are paying a cost of limiting the types of contingent actions to things that are compatible with the current RTGS system. But it's a very, very important first step. And the ECB is thinking of this very much in terms of an interim step. But of course, there is the ultimate goal, which is to have central bank money on the platform. And it's by doing that that you're really going to be able to harness programmability in its full sense. If you do it through the various triggers, there are the usual problems to do with, what about the latency? What about the types of, how refined can the instruction be, and so on. On the platform, the only thing that's limiting you is how creative you are. So there's full atomic settlement. And this is the vision behind Project Appia, which the ECB, I think the blueprint will be out there in 2028, Appia. Appia, as you know, is the famous Roman road. So you see that there's a little bit of a theme here. There's the Roman road, there's the bridge, and then there's the river. So it's you see the very consistent theme. Now, what we did in Korea is to go straight to that second solution. Without going through the RTGS intermediate step, we're going straight to the full platform. And we're putting central bank money on the platform through on and off ramps. So what the bank does, what a commercial bank would do, would be to take some of its reserve balances at the Bank of Korea. What the Bank of Korea does is to move some of that money to a separate sub-account. And for every one that's in the sub-account, there's a tokenized version of central bank money on the platform. And then we have everything on the platform. The money is frozen in the sub-account. So there's no net money creation. There is the need for additional liquidity, and I'll come back to this because clearly there's going to be a fragmentation of liquidity in this sense. But the beauty is that everything just transfers from standard deposits to these tokenized deposits. So the usual rules on reserve requirements, deposit insurance, and prudential regulation all transfer over to tokenized deposits. Now, one way that we design this is to have a separate value layer where all the claims are circulating from the actual detailed programming, because it turned out that that was much simpler and it was much better for operational risk. But it doesn't have to be like this. You could have it all in just one ledger. Another choice we had to make was, of course, technically everything is feasible, but in terms of the institutional background, the institutional backdrop, there are governance issues that need to be handled. So in particular, depending on the particular asset, there will be other interested parties that need to be involved in having tokenization. For example, if it's government bonds, you need the Ministry of Finance, you need the centralized securities depository, and there are many, many different pieces, and those need time to actually sort out and put onto the same platform. Now, we completed the first phase last year, and this was actually a live trial. We had 7 commercial banks, about 80,000 users, and around 12,000 merchants. We had a very well-known supermarket chain, convenience store chain, et cetera, and I think what we learned was that the unified ledger actually can work at scale in real transactions. And for the user, it's very much like just using a standard payment app. And because the merchant fees, and because we don't have credit cards, debit cards in the middle, of course, for the user and for the merchant, they can actually skip over the, those fees. So this was a tremendous cost saving for the merchants involved. What we're doing later this month, so at the end of July, we're launching phase 2. And here the big theme is the implementation of public spending. So in particular, disbursements of public funds. It could be in the form of procurement, and the examples I'll give you are very much in the form of procurement. But it could, if you want to, use this type of system to disperse benefits as well. But I think this is where you see the full power of tokenization. Now, the government has a plan to use the tokenization platform that we have to disperse a quarter of all the central government treasury payments by 2030. So a quarter of all central government spending will go through this system by 2030. That's the objective. And let me give you one example of how procurement becomes much easier if you have tokenization. So in Korea, we have a very ambitious program to lay out a national network of electric vehicle charging stations. And we've set standards, but then of course the work has to be done by the private sector. So the question is, how do we enforce standards, make sure that the money goes to the manufacturers of the charging stations, the building firms that will build the infrastructure in a way that is going to be free of the most egregious forms of fraud and misuse, etc. And of course, it's going to be very, very difficult to check these things ex post. So why don't we program it ex ante? And that's what we are going to use it for. Now, this is the current system. So we have a fund which will fund a subsidy for these new EV charging stations. And there are the charge point operators. These are the firms that will organize the building of these things. But of course, there are subcontractors that will actually do the work. So the manufacturers and the builders who will actually build these things. And we want everything to be up to standard. And so only some only some types of chargers will be eligible. So how do we do this? Well, of course, we can program it. And we don't need to pay the operator. We can go directly to the subcontractor. So to the manufacturer, to the builder. And that way, these firms, in turn, will see working capital. Their working capital situation improve tremendously as well, because they're getting money directly without having to wait for the intermediary. And then the qualification can also be programmed in from the start. Of course, this is a very, very small example of what can be done more generally. And government procurement, as you know, can be very, very complex. And ex post verification just is not really a very useful way of going about it. Another example is something very close to home, which is, as public officials, the Korean civil servants, even the central bank, were issued a official payment card that we use in the course of our daily business. And that's also a form of procurement, because what you're doing is you're procuring services. So here's mine. I'm going to obscure the number. So this is my official procurement card. And of course, you can use it to entertain, guests for your official business, or for travel, or for hotels and so on. But it's going to be, but of course there are very strict rules about what's allowed and not allowed. And how do you enforce that? Well, currently it's all enforced through ex post verification. And that's very, very time consuming, very tedious. Of course, we can program everything so that it only works, your card only works for approved purposes. And thereby you can skip a lot of the intermediate checking steps. So this is the spirit. You can harness programmability. You can harness tokenization to program in conditions ex ante, rather than having to check and verify ex post. And for the economic theorists in the room, we know that the ex ante equilibria are much larger than the set of subgame perfect equilibria, ex post equilibria. You can achieve a lot more if you have the ability to make credible promises that you cannot if you only have to rely on ex post incentives. So looking ahead, of course, I've given you two very small examples, but that's going to be the spirit of the projects that are coming up. Of course, the big prize is tokenizing government bonds. And this is not only about developing the capital market, it's also about implementing monetary policy. Because think about what's involved in a repo transaction. You need to verify the collateral, you need to credit the account of the asset provider, and you need to reverse that transaction at the right time. And these things are just much easier, much less prone to mistakes if you have everything tokenized ex ante. And since Pablo is here, let me also say something very, I feel very much attached to this project, which is Project Agora. I was very much involved before I left the BIS. But this really is a very, very promising system. It really is the next generation of the international monetary system. And the way it works is every jurisdiction has its own national ledger, its jurisdictional ledger, and the jurisdictional ledgers are themselves connected via the unifying ledger itself. Currently, it's the US dollar, the euro, the yen, pound sterling, Swiss franc, Korean won, and Mexican peso. But I see TIF, Canada is joining this year, so there'll be 8 central banks involved. And with Project Hangang, I can confidently say the Korean jurisdictional ledger is done. So we just need the other jurisdictions to come along, and we can just plug in. Anyway, thank you very much, Christine, again. Thanks for the invitation. Very much look forward to the discussion.
Okay. It's a real pleasure to be here. Of course, to discuss a paper by Hyun-Shin on a fascinating topic. And I should say that I started working on this topic of blockchains and Bitcoin for 10 years at the initiative of the Banque de France. So I can say that central banks and, of course, the BIS have been at the forefront of these questions. So for this discussion, what I will do is that I will briefly set the project, at least its phase 1, into context, and then raise 3 points to discuss. Okay. No, it doesn't work. Okay. So this unified ledger project has two main characteristics that you have to remember. The first one is that it settles bank transactions using digital central bank money on a distributed ledger. The second characteristic is that it leverages on smart contracts or programmable features to implement what is called this atomic settlement of transactions. What is the atomic settlement? If you have a bank transaction represented by this figure, you need to have the two black arrows being recorded. The atomic settlement ensures that you cannot have only one of the arrows recorded. You have either two or none. Now, of course, this project, so it's already relatively large scale, as Yunshin presented. It's part of a series of central bank and BIS experiments to introduce settlements with digital central bank money. Several of these projects have been mentioned. But what is new here, and you understood it, is that it's the first live experiment of a unified ledger, and the good news is it works. Okay, so far the system replicates exactly the current settlement system and the two-tier monetary structure. So does it mean that it won't change anything? Well, this is a little bit what we are going to discuss. What main changes will a unified ledger bring to the landscape of financial payments? So the broader context has already been explained, is of course the rise in the last decades of cryptocurrencies and decentralized finance services, fueled by the development of stablecoins. Now, in the last years, in the very recent years, what we've seen also is the development of so-called tokenized finance, that is tokenized assets and products offered by traditional financial institutions. We've seen the rise of some form of tokenized deposits, and also what are called, there are all these acronyms, real-world assets like tokenized mutual funds, money market funds, traded on-chain. Now, these tokenized assets, in a large part, are also sustained by stablecoins. So what can a unified ledger infrastructure do in this setting? Well, it can enhance, of course, the development of this tokenized finance through, I would say, two benefits. One is the one that was described earlier, or the efficiency gains that you can have within what we call the traditional finance sector by having these cheaper, faster, and more adaptable contracts. And on that aspect, I had a question for Yunshin. So the nice aspect of the project is that you run in parallel the new ledger with the standard settlement system, and I was wondering whether you had any quantification of these efficiency gains, because we talk a lot about them, but we don't know how much you can gain. And the second one is, of course, that you can enhance the competition vis-à-vis the crypto or the decentralized finance sector. Why? Because you have a ledger with both the assets and the payments recorded, and it is backed by central bank money. Okay, so I will build on that to raise 3 points. Can tokenized deposits sustained by a unified ledger compete with stablecoins? Second, if we have these tokenized deposits, again with a unified ledger, do we still need, what would be the role of a retail central bank digital currency? And then I will say a few words on financial stability. So stablecoins, as you know, they have several usages. They are used, of course, for crypto trading. They are used in decentralized finance services like DeFi lending. And they are also used for payments by fintech firms and even for retail cross-border payments. Now they're called stable coins, but you know they are not fully stable. They have some risks. You can have deviations from parity, either because the redemption system and the market structure creates limits to arbitrage, or because you can have stress events, as we've seen with Silicon Valley Bank. But more fundamentally, stable coins are currencies backed by some reserves. If those reserves are insufficient, if they become illiquid at some point, you have the risk of a run and of a default of the issuer. And not to mention that sometimes they can be used to sustain illegal transactions. So you see, tokenized deposits backed by a unified ledger with central bank money can solve many of these issues. You have the benefit of the technology. You can ensure parity with a fiat currency. And of course, you can benefit from, since these are bank deposits, the standard regulation of deposits. It's easier to pay interest, and they are insured. So will they divert the demand for stable coins? Well, there are probably different natures of demand for stablecoin. If we think about users in emerging markets that use stablecoins for other reasons, probably that won't change much, because these users, if they are retail, sometimes they are unbanked, or they really want to trade in, for instance, US dollar rather than their domestic currency, or maybe for ideology. But for firms and institutions, it might well be the case. Of course, the key issue is interoperability with the other services that these financial institutions are using, and also whether this unified ledger will offer a sufficiently large network to cover the needs for cross-border transactions. Now, in that respect, I would like to focus on one aspect. The governance of the ledger could be an issue. So all these central bank experiments, they rely on permissioned blockchains or permissioned ledgers. Now, the advantage is that you choose your friends. You choose who is in, because you grant some form of control rights to verify. So the disadvantage is that you need to trust those who are in. You need to trust them now. You need to trust them in the future. And naturally, that will limit the scale of the network that you can create with these permissioned ledgers. Now, in contrast, in permissionless blockchains or ledger, you don't need trust. And automatically, that can foster a larger international adoption. So that's one important aspect. Now, the second point I wanted to raise was about the role of retail central bank digital currency. I know it's a topic these days. So I won't go over the whole debate on the use of a retail central CBDC. But I would like just to ask one question. If we develop tokenized deposits in banks which are backed by central bank money, do we need also a retail central bank digital currency? I mean, I'm thinking of myself. I know a little bit the system, but still I might be confused with all these different, euros, and maybe that could be an issue. A last point in 45 seconds: financial stability. Okay, what we've seen in the last years is that this rise of decentralized finance has created more and more channels of propagation of stress events between what we call the two sectors, the traditional finance and the DeFi and the decentralized finance. With the entry of DeFi into traditional finance, well, an example with the regulation of stablecoins and the use of bank deposits or sovereign debt, you can see that stress events can propagate both ways. With the entry of tokenized finance and traditional financial institutions into DeFi, we still have another channel of entry. Now, will a unified ledger solve the problem? It's not entirely clear. Because if it means that it will develop even more tokenized finance, it might be that you will have even more links of transmission. And so the conclusion is for central banks to keep working on the issue, because I think the mission of central banks will not become simpler in the future. Thank you.
So, thank you for this discussion, Professor. So let me give the chance to Yun to reply.
Thank you, Catherine, for this very, very good discussion. I'll just take the question of governance. I think that's the key one. And of course, if it's simply central bank money and commercial bank money, governance is within the existing arrangement. So there's not really much more. So something to do with payments won't need that much more. But as soon as we have something else, there will be other interested parties. And yeah, let me just stop there, because I think we can go into this in much greater detail and maybe with some other questions.
So I guess there is lots of interest in the discussion. I have Pablo, Isabel, Dirk, and then we stop for the second round. The second round will be the gentleman next to Dirk, and then Governor Panetta and Governor Nagel. Please.
Thank you very much, Hugh. Great presentation as ever. Two questions. First one, what is preventing tokenized deposits for us to do faster? That's my first question. With the experience that you have at the BIS, with all the Project Agora, and now with the experience that we have in Korea, why we are not quicker on delivering on this? Is the governance issue mainly the problem? And then second, what is the main improvement for citizens? You were part of the conference that we had in Basel on Friday. There was this exercise on which cross-border payment was simulated through the current system, through big techs, through stable coins. It was very clear that big techs have, allow for a significant lower fees as compared to the traditional banking system. Not so much stable coins. I think it was similar to the question that Catherine had. What implications in terms of cheaper transfers cross-border would this unified layer imply?
Isabel, and then Dirk. Isabel.
So thank you, Yun, for a fascinating presentation, and in particular, congratulations on this incredible project. So very well done. So you described the way that the central bank provides tokenized reserves, and you have this separate account at the central bank. So my question is, why is this preferable to a private payment service provider doing this issuance of the tokens? So what is the reason why this provision of the tokens could not be done by a private payment provider?
Dirk, then we go for the first round, and then... No, first Dirk, we close, then we have Governor Panetta, Governor Nagel, and then the gentleman next to you. Please.
Thank you very much. Related to Isabel's question, I guess, the banks could come up with the idea to form some joint purpose vehicles and start to issue a joint token in order to simplify the process dramatically and get the central bank out of the picture. Is that something that you would encourage, or you would sort of not encourage? And on the operational level, does the Bank of Korea fully delegate decision power to the algorithm, or is it in the end of the day the Bank of Korea that says, okay, I have the green flags from all sides and let's go for it? Thank you.
Okay. So you, please. Why don't we take this first round, and then we go for a second round, and the third round possibly.
So Pablo asked, with tokenized deposits, why are we so slow? I mean, there are tokenized deposit platforms that are run by individual commercial banks, and we know them. There's one big bank in particular that's very famous for this. But of course, those platforms can only serve customers of that bank. What we need is something that covers the whole system. And so either it has to be something like a consortium that Dirk has mentioned, or the central bank needs to be there to settle. And what I'm expecting is that as people become familiar with this type of platform, speed will pick up, because it's ultimately not very difficult. And it's, it was only 2023 when the BIS published its chapter on the unified ledger. And 3 years is really just a blink of an eye, in the big scheme of things. Is it cheaper for users? That was Pablo's second question. And the answer is absolutely, it's much cheaper. And it's cheaper especially for merchants, because as you know, the merchant servicing charges are really quite hefty, but consumers don't necessarily see it. But of course, ultimately, consumers end up paying it through higher prices. And I think this is, even in a domestic context, there's a tremendous cost saving. In fact, during the COVID fiscal disbursement in Korea, there were various schemes which used card companies. And it only emerged, somewhat later that actually the card companies were taking a big cut. And I think with a system like this, it's going to be just much easier, much cheaper. You don't have to pay the large card companies. Isabel and Dirk both asked the same question, I think, which is, could the banks not simply get together and leave the central bank out? I think that's one way to do it, but of course the platform ultimately will have to, the netting is going to have to happen anyway. And you see it, for example, in the CHIPS system in the US. There are very, very similar systems where even if you have a bank-led platform, ultimately the settlement has to be done on the RTGS. And so if that's going to be the case, why this two-step process? Just go straight to the central bank. And I think that just seems a lot more efficient, and it's more secure. But it does raise this interesting design question between Pontes and Appia. With Pontes, you're linking it with the RTGS. And of course, the RTGS can program some basic functionality, DVP, PVP, that kind of thing. But for anything as complex as, let's make sure that public procurement for EV charging stations satisfy these rules, I don't think the RTGS is going to be able to handle that. And not to mention the public officials' payments. Yeah.
Catherine, do you want to chip in on this question? So you have anything to add?
Well, maybe on the last question on whether banks could, do the same thing among themselves. So first, there are some initiatives of tokenized deposits by banks, like the JP Morgan dollar. Of course, you can have the netting on us, inside the bank, but now it's also traded on a public blockchain. So you could imagine that several banks would use these public blockchains to do that together. Of course, you still miss the settlement part. At some point, you need to, even if you exchange those tokens, you need to get upfront to get your money back. So it's the current situation of tokenized finance that trades on chain, and then you need to get the settlements.
Okay. I have Governor Panetta, Governor Nagel, and then the gentleman over there. And the next round I have Cecchetti, Lucrezia, and Tobias.
Thank you, Yun, for your very insightful presentation. And thank you, Catherine, for your discussion. One first observation is on the scalability of DRT. Now, we are in the Eurosystem, as you mentioned, building a similar system. And wholesale CBDC means interbank trading. And in interbank market, you have a limited number of institutions, and the transactions are not so numerous. I was wondering whether the technology is available to scale the use of DRT when you apply the single ledger, not just to interbank trading, but when you include also bond trading and other trading of tokenized deposits, whether the technology is available for such a scale. Second, the utility of the system you have described is maximized when the various national systems are linked in a single ledger. And then the governance issues that you mentioned are magnified, are amplified, because issues on who owns the data, who guarantees the privacy of the information, who decides on any dispute emerge. So what would be, in your view, the governance that would minimize possible tensions, frictions? Because we would have that problem. Technology is not an issue anymore, although the systems are complex to build, but the issue, the important issue is governance. On tokenized deposits, Pablo asked why banks are not using them as much as they could. Well, if you tokenize deposits, deposits become more flighty, and banks do not. There are a number of economic and financial implications. Maybe banks don't like to see their deposits becoming more mobile, more reactive to changes in interest rates. So, for good reasons, they are slow, and they are waiting until they are forced to move to tokenized deposits. And last, sorry for being long, last comment on your ex-ante versus ex-post verification. Ex-ante is certainly more efficient, but I would be very careful to use this argument, because when we discuss the digital euro, for example, in Europe, people, citizens fear exactly that a digital payment system operated by public institutions could be used to control, for example, their purchases. Suppose that one government would not like one day its citizens to buy alcohol. Then it could block any purchase of alcohol. And a number of other ideas, crazy or not crazy, could emerge. So when we were discussing, when we discuss still today the advantages of the digital euro, retail CBDC, people say, oh, but you will use this to impose constraint on us, to control our taste, to impose us your decisions on what we should eat, drink, and that's a difficult argument to use. Thank you.
Yeah, we call it conditional payments, just to make it up.
Conditional payments. So my question is much easier than the questions from Fabio. I would like to come back to Hangang, your project. And as far as I heard it from you, this was a test, it was a pilot project, and it was used by 80,000 users. But Korea is a country of more than 50 million people. Do you have the intention now to scaling up Hangang and make it more broadly used? This is the question, and I have a comment related to the question, is retail CBDC the solution? I believe, yes, it is the solution because of one simple reason, that I think that payment systems at the end are of a systemic relevance. And I could remember very well the time back to 2008, 2009, when there were countries that didn't have during that time a domestic payment system. And they were very concerned about that period, that maybe things getting really wrong. So I believe at the end it is of utmost importance that the system is backed by central bank money. All the other solutions are good solutions, definitely. They're smart, but we shouldn't forget crisis situation is a different situation. And then often private solutions are not working in the same way. They're working when the sun is there, when the sky is blue. So we shouldn't forget this. Thank you.
The gentleman, then we go back to the speakers, and then we have hopefully a third round. But we need to be very efficient.
Thank you very much both for the presentations. Actually, I have 3 questions about the hanging project for the phase 1, phase 2, and for actually looking ahead. The phase 1, I would like to ask, you show a very important part related to the possibility that the producers or providers directly receive the money. There is no need for some in between. What is the acceptance ratio? How that works actually in the real world, and how many companies actually are involved there? The second, related to the payment, actually you showed the card and everything else. How that affect the payment providers? I mean, MasterCard, Visa in Korea, do you see any reaction from them? And the third actually is related to that. For example, you said that Korea is with the phase 1 and phase 2 actually they're ready for the ledger of interoperability. What is the, for example, if the all systems, I mean the Euro, American, others are ready for that, what is the realistic operability of the ledger in between all the providers, I mean national providers, and who will bear the risk actually on that platform? Thank you.
Jun, please.
Very good.
We have 3 minutes and 45 seconds, and we'd like to have another round.
Let me be brief. So we can. I'll give you the full answer during the coffee break. But I think Fabio asked a very important question, which was on the governance. And of course, the governance very much depends on what's actually on the platform. So if it's just a payment system, if it's central bank money and commercial bank money, the governance just stays the same. It's the current system. So that's the easiest example. But as soon as you have something else going on, then you need to bring on other interested parties. This is why it's always the governance which slows things down, not the technology. The technology is very, very simple. It's the governance, and that takes time. I mean, it's difficult enough in the domestic context, but if you have something which is cross-border, then it's going to be even more of a challenge. Although I think the way that Agora is designed, everything is modular, so you have the national jurisdictional ledger, and those are just combined. That makes it much easier. I think the easiest extension would be the trading of government bonds, because in many RTGS systems, I mean, Fedwire actually has settlement of bonds. And I think that's something that we could easily do within the existing system. But of course, we need to bring in the Ministry of Finance, the CSD, the Centralized Securities Depository, is another interested party. So those discussions need to be had, but that is a pretty low-hanging fruit with huge rewards. So we should get there as soon as possible. Joachim is asking why not, I think you were making a claim, not a question, which is we should have a retail CBDC. And I think that's certainly, I think for the euro area, there are very strong arguments for that, as the euro area-wide infrastructure. But it does actually raise, Joachim, the questions that Fabio raised about privacy, about the sense that this might be a way of control sort of seeping in. And I think this is where the balance needs to be struck. My sense is that doing it through tokenized deposits, that's preserving basically the current system. So it's neither more nor less intrusive than the current system. On Visa and MasterCard, actually, the card scheme for public officials involves neither. It just involves a local card provider. And but I can give you the full answer during the break.
Thank you, Ian. We are ready for 45 seconds. So please, 3 sharp questions, and so that we allow. So Mr. Cecchetti, Lucrezia, and then Tobias. Please, three questions, non-comments, otherwise we will be not able to close it.
Steve Cicchetti from Brandeis and the ESRB. My question is about DVP and atomic settlement and the trade-off between the trade-off that exists between counterparty risk and netting benefit, counterparty risk costs and netting benefits, and how you see that in a system like the unified ledger.
Lucrezia and then Tobias.
Yes, my question is about what's going on in Europe. It seems that banks are forming a consortium not to do tokenized deposit, but to do stablecoin. That's a Equivalis consortium of more than 30 banks. So it is likely that banks will want to be in both tokenized deposit and stablecoins, and this will be very challenging from a regulatory perspective. So it is likely that we will have a hybrid system. And so what are your thoughts of how to govern a system in which we'll have all kinds of issuers and banks themselves issuing stablecoins rather than tokenized deposits?
Tobias.
Yeah, I wanted to follow up on the broader tokenized finance question a little bit. We have seen that CCPs such as DTCC and also European counterparts are moving towards tokenizing or offering tokenized settlement systems. We're seeing money market funds and mutual funds, ETFs being tokenized. All of this is sort of emerging, but there is sort of like the possibility of having a tokenized, market-based financial system in complement to the banks and the payment system. So if you could say a little bit more on this broader, tokenization of finance, of traditional intermediaries.
Please, you.
Very briefly, so I think, Tobias, you've written the chapter on this, so I think I would just recommend you read the IMF report. Of course, there has to be the settlement infrastructure behind it, and I would say, that's where tokenization can really, that's, I think, where the central bank, that's where central bank money really comes into its own. I mean, the idea that you can settle, huge, bond transactions using stable coins that might fluctuate in value, I think that's not really going to be, that promising. Which leads me to Lucrezia's question, can they coexist? Yes, they can coexist. And I have viewers from Korea, so let me just say again, they can coexist. And it, of course, but they are fundamentally, different solutions, and they're not going to be interoperable. I think more generally, just going back to Tobias's point, the whole stablecoin universe is only around $300 billion worth. Now, not all of that is going to be used for settlement. There's a lot of tether that's mainly there as a dollar store of value. Basically, that's the amount of collateral you have to secure the blockchain and to lift the whole global financial system on the basis of $300 billion. That's really going to be a push. In the way that stablecoins work, in the way that Ethereum or the other blockchains actually work, securing that through proof of stake, etc., and supporting the whole global financial system on such a small amount of collateral, I think that's going to be a challenge. And Steve, DVP, yes, of course. But the idea is more that you can do more. So it's not simply doing what we do currently, but better. It's we can expand the stuff that we can do. And so I think that's really where the big gains will come from ultimately.
All right. I guess I have an answer to, I guess, Lucrezia's question was toward me being. So essentially, we have clarified this very clearly in our both retail payments strategy that we published at the beginning of the year in the Appia roadmap. So what we are constructing is a platform where you can have public form of money in tokenized form, being the central bank money, and any form of private money, including stable coins. What is actually, we think that having such a platform will help also the business case of stable coins. Why? Simple, very simple example. Imagine you want to have a secondary market for stable coins. How do you pay? Without central bank money on the ledger. So this allows you, this explanation is saying to you that we are constructing a platform and then let the market decide what kind of user they want to take, because I don't think there will be one solution that is fit for all use cases. There will be an envelope of solution, each solution that fits better the specific use case. Three more quick observations. On the tokenization, in Europe, the French Treasury and Euroclear are launching a very interesting project, which is called Pythagore. So they have essentially tokenized all the commercial paper. So this is a very good start. Third, on the private sector initiative and the ability of the private sector to solve the problem in Europe of the retail payments, we launched in 2016 the scheme. In 2018, we launched TIPS, which is essentially, it's not tokenized, but it's an account to account. So the private sector could have exploited that to construct a unified sort of ledger, but we didn't see anything. For many years, we saw 40,000 transactions per day. So we are stuck in a bad equilibrium, and we need something to move us out of this bad equilibrium. With this, we are 6 more minutes late, but I hope it was worth postponing for some minutes the coffee breaks, because the discussion was worth it. Thank you very much.
It's definitely worth postponing. Thank you for getting them morning off to such a good start to both of our chairs and all of our panelists. We're now going to take the very well-trailed coffee break. Please be back here in 20 minutes' time. Thank you. Thank you. Thank you. If I could ask you all to take your seats, the session's about to begin. We're witnessing the most dramatic transformation in the global trade landscape in decades. The next panel will ask, what has changed? What are the costs? And what should Europe's new role be? It will be chaired by the ECB's Executive Board member, Philip Lane. Dr. Lane, the floor is yours. Thank you.
Okay, good morning. So first of all, let me reassure you, my one KPI for the year is to finish at 12:45. Okay, so that will happen. So please take that into account. No. This is the only one. Now, someone asked me just now, what is this topic doing in this conference? But actually, for Europe, which has been a global trading engine for decades, of course, this topic had to be on the program. Both in terms of innovation and we had this really nice discussion in the immigration panel this morning about how much migrants bring, how much we learn, and it's the spillover into FDI, into knowledge flows, and so on. So trade and growth go together. Trade and innovation go together. And of course, even though we get shocks to global trade, central banks have to think about the stability in responding to that. So then the question is, okay, what do we mean by the new global trade landscape? And I suppose you might have a narrow perspective and you say, well, there's now these US tariff policy. Or you may say, well, I'm noticing a big surge of exports out of China. Or to some people, they say, well, Europe is now, with the carbon border adjustment tax, changing the global trade regime to align with the environmental policy. But I think on top of that, we have every day now more and more evidence of how technology, AI, is driving a new tech boom in trade around the world. And we also, of course, have this widening of the trade discussion to include political considerations, so economic security, choke points, resilience, and so on. So I'm really pleased that we have been able to attract a very good panel to talk about these issues. So from my right, Laura Alfaro is really here for two reasons. In her academic career, Harvard Business School, she's really been doing a lot of great work recently on how is the world reshaping trade dynamics in this new environment. But Laura is also the chief economist of the Inter-American Development Bank. And trade between Europe and Latin America is a super important topic. Marion Jansen is the director of the Trade and Agriculture Directorate of the OECD. And the OECD is such a fantastic resource for trade-related issues. Ralph Ossa, maybe a bit like Laura, is here for two reasons. As a very distinguished academic career and currently at Zurich, professor at Zurich University. But until recently, he was chief economist of the World Trade Organization. And Denis Redonnet, who's coming from the Director General for Trade and Economic Security at the European Commission, has a fantastic job title. So he's Deputy Director General, but he's also the Chief Trade Enforcement Officer. This is a real chief position. So the format is each will present for 10 minutes, and then we'll take it from there. So Laura, please.
well, while I wait for the slides. First, thank you very much for inviting me back to Sintra. Let me first start by expressing, in the name of the IDB group, our condolences to the families of the victims of the earthquake in Venezuela. Our thoughts and prayers are with them. But also let me thank the people, the nations that have been helping, and in particular, the EU. I know they have been supportive, and also our host country, Portugal. So on that, let me, in these uncertain times of trade, technology, geopolitics, let me make 3 points. Resilience has held, but constraints remain tight. Technology transition is reshaping the region, and there are opportunities in the Union, Europe, Latin America, exploiting energy, technology, critical minerals. They offer opportunities, but we know that policies will determine outcomes. Resilience. I have shown this picture that is a lot of dots. It has measures from Carmen Rehan and Kenneth Rogoff of different forms of crisis: currency crisis, banking crisis, domestic debt crisis, external debt crisis, and inflation. I'm using Ken Rogoff's and Carmen Rehan's indicators, but Luc Levan has similar indicators. And I don't want you to necessarily get all of these. These are different countries in Latin America. What I want you to see that if you go back to the 70s, 80s, and 90s, you see many dots. Started in the 2000s, you start seeing less dots. Some of the dots, and I always use this joke, are concentrated in the countries in Latin America on top of the list, and the ones in the bottom of the list. But even those countries are making efforts to improve. This change in the number of crises that we're having is not luck. It's the outcome of improved fiscal and monetary frameworks, financial supervision, and deepening. We have strengthened many of our domestic variables. Most of the countries have now credible, flexible exchange rates. We have now deeper local currency markets, which shows that the original coin in IDB by Ricardo Hausmann was not original. We could improve our frameworks and issue domestic currency debt. We have very strong banking systems that have allowed for resilience. We have new players, new instruments, hedging instruments, and also we have innovation in digital finance and payment systems, for example, fintech and PIX in Brazil. All of these improvements have allowed us to experience historically low credit risk, which have allowed us to compensate the higher international interest rates. And so even though our public debt remains high, on average it's not increasing, but we know we have to do more. We also know that resilience is not immunity. We need to look for new opportunities, improve our growth, improve our productivity. And here are the opportunities. We argue that trade continues to work an opportunity. In work that I have been doing with David Chor from Dartmouth, we have argued and continue to argue that we are not deglobalizing. Even the US continues to engage in trade with all of the countries. What we're seeing is a reallocation of trade patterns. From the point of view of the US, this has been a very clear move away from China into some other regions, and in particular, Latin America has benefited from this reallocation of global trade. In the graph to the right, you can see that China used to be the main trade partner of the US, and now is Mexico and Canada. The chart of the right also shows that even though there has been this reallocation in the top 10 trade partners of the US, it's very hard to reallocate away once you start going to 80% of the trade, 90% of the trade, because the number of industrial clusters in the world is limited. But there has been reallocation, and at least from the point of view of Latin America, we have benefited from the interaction with the US. Interaction with the EU is a little bit more mixed. On average, perhaps it has gone down a bit when we look at the whole trade with Latin America, But when we focus with Mercosur trade partners, which have been actually historically some of the main trade partners between Latin America and EU, we have seen some reductions in this interaction. We argue that we have a lot of opportunities that both regions can exploit. As was mentioned yesterday by Monica, the new innovation wave is energy intensive. Latin America is second to no other region in the generation of clean electricity. Second to none. And I saw your face, I usually get this face. People don't know this. We have hydro, we have wind, we have sun. We also believe in diversified sources of energy. We believe in nuclear, we believe in gas, we believe in oil. A well-diversified matrix is an advantage in these complicated times. We have countries like Brazil and another one close by that I don't want to mention because of World Cup. They go 100% electric energy because they have Itaipu. So this is a source of benefit for both regions. We can exploit this advantage. Energy requires metals, requires copper, requires lithium. Latin America is also blessed with a lot of critical minerals, and there are opportunities for both regions to exploit these advantages. We know very well that geology is not destiny. We are the region of the resource curse. So we know that these policies need to be implemented wisely, with care, paying attention to volatility and to manage our fiscal frameworks. We have a very healthy pipeline of FDI, not only in mining, but in other areas. And in fact, FDI has proven to be resilient in the region. And we also have held very healthy reserve buffers. But even in the world of FDI, that allows us to share knowledge, skills, management know-how, and also maintain the resilience, Europe as a partner, the share has come down. The US continues to be a reliable partner, and it's important for Europe to re-engage with Latin America. And we have many initiatives for that. Trade and investment initiatives, again, we are one of your main trade partners. We have agreements. We have now finally signed the EU-Mercosur agreement. But when I was in government, we negotiated the EU-Central America agreement. And again, there are a lot of opportunities in this trade. We have also opportunities in FDI. And IDB also has a lot of cooperation with EU, not only for responsible investment, inclusive growth, energy transition, but we also have a critical mineral initiative. So conclude, resilience has provided the foundations, technology and energy creates the opportunity, and what can shape Europe's future to look back and look at the opportunities in Latin America. Thank you very much.
Thank you, Laura. I'm still trying to think of what is the omitted World Cup country. But let's move on to the second presentation. So from Marion Johnson, please.
Thank you very much. I'm very pleased to be here today. My name is Marion Janssen. I'm the Director for International Trade and Agriculture at the OECD. The OECD is an international agency with 38 members. The United States is a member, South Korea, Japan, but also 22 European countries, and one important trading nation is not an OECD member, and that matters, and this is China. I'm going to present you 6 slides, 3 charts, 3 pictures, and I hope that with these 6 slides I will manage to show a portfolio of work of the OECD on international trade, nevertheless in a concise way and with a hopefully coherent story. First one here, I invite you to concentrate on the left side. Really the starting point of my discussion is to highlight the theme that I want to concentrate on in this presentation, which is the theme of supply chain resilience, and a theme that is linked to the topic of economic security. A simple chart here, I could have chosen other ones. It shows how the world depends for its imports, the left hand, in a concentrated way on a few suppliers. And if you look at the overall chart, you see not much of a change, relatively flat. But what has changed is whom we depend on. I invite you to look at the bottom of the chart. There's this blue color here that increased. That is China. Over the past 20 years, increasingly the world has started to depend on China for particular products, and that has gone at the expense of dependence on other countries, OECD countries, blue United States, orange Japan and green, orange Germany and green Japan. So concentration has changed in terms of whom do we depend on, increased dependency on China. There are a number of discussions around this because dependency can lead to vulnerability to exposure. One question, however, is how did we end up in this situation of this over-concentration? And one reason that is being discussed is the potential role of subsidies of industrial policies. The OECD recently released a pretty unique data set that allows us to measure subsidies as they have been received by companies and at the firm level. As a result, we can express subsidies in terms of firm level revenue, and you can look at subsidies in relationship to the profit margin. That gives you a pretty good sense of the distortive potential of subsidies. In this chart, I show you how subsidies are being deployed across the 15 sectors that we cover in this data set. And you see that in the 20 years, on average, that's the bars, the most subsidized sectors have been solar panels, semiconductors, aluminium, wind, and ship. That's a blue one. But in 24, it was solar panels, semiconductor, steel, aluminium, and wind. What you also see, the dots, that's the 24 data, higher than the average, the bars, so increasing use of subsidies across the board. What you do not see on the chart is that we find that across the sectors, China has tended to subsidize more than other countries. We find values of 3 to 8 times more than other countries in the sample. And we can also link, through econometric work, we have linked subsidies to global market share, and we find that up to 60% of market share increase of Chinese firms can be related to the use of subsidies. This is leading to a lot of discussion right now, notably in the G7 and G20 context. It's an important finding because it is a finding that suggests that the rules of the WTO that are meant to discipline the use of subsidies and to avoid that subsidies can distort markets, that these rules may not have functioned. This is, again, a very important discussion at the WTO, including under the WTO reform process. On this slide, something else. If our imports are concentrated, in particular if we depend on one country, and if that country uses export restrictions, doesn't give us access anymore to that product that we need, then we have a problem. And you may have remember that a few months ago, China has restricted access to rare earths. This is not new. They already did this during the financial crisis. They didn't provide access to Japan and a number of rare earths. And that's when we started to collect data on export restrictions for critical raw materials. And what you see here, that is over the period, over the 18-year period that we cover here, the use of export restrictions has increased 5-fold, so more exposure to the weaponization of trade measures. Those were the charts, now the 3 pictures. Here first, a picture on a report that we published last year, the OECD Supply Chain Resilience Review, published in 2025. When I was asked by journalists at the time, what should we remember from this report? I said the first thing you should remember is that it exists. And this was important because when we started to work on supply chain resilience a few years before, this was a completely new topic. When I was working at the WTO, well before Ralph, nobody was talking about resilience. We were only talking about efficiency gains of trade. Now resilience is the topic, and we have to find a way to link this, to find a way forward to marry resilience and efficiency gains. We do emphasize in this report that supply chains are run by firms, that firms have a way to deal with risks, that they have increased investments in doing this since the great financial crisis, that governments may nevertheless have a role in supporting supply chain resilience and economic security, but that have to accompany firms, not to replace them. And we say that moving to autarky is definitely not the thing to do, that we should rather think about more cooperation across borders in order to make it easier for firms to switch suppliers, in particular in moments of crisis. So much about the first picture. Now 2 buildings. This is the OECD, Le Chateau. You see a bunch of people in front of the Chateau. These are people that are currently negotiating. So this is one of my positive messages to this group. Negotiations are happening, and in this particular case, on a tool that is relevant for the story that Laura just presented. The OECD hosts something called the OECD arrangement on government support to unofficial export credits, the OECD export credit arrangement that has existed since the 70s. And it's a very interesting tool because export credits are a subsidized tool. But here members have agreed, since the 70s, they agree not to outcompete each other in a too unloyal way and not to enter into subsidy races. Export credits can play an important role to facilitate not only trade with other countries, but also investments, for instance, in mining projects, for instance, in Latin America. And what our members have found is that by sticking to the rules, not to enter into too aggressive competition, they cannot compete anymore with other actors out there, notably with China. They're currently discussing how to make rules more flexible and in particular to make them more applicable to investments in critical minerals mining projects, because there our members consider that there is an important urge to move away from over-concentration in markets towards more diversification and has hence reduced their exposure to, for instance, export restrictions. Last but not least, here another building, the WTO. One of the discussions that is currently taking place is whether one of the key pillars, one of the key principles at the WTO, the so-called MFN principle, is still fit for purpose in this context where countries want to move towards more diversification. So remember two acronyms from my presentation: MAGIC, the MAGIC database on industrial subsidies. It stands for Manufacturing and Joint Industrial Corporations database, but MAGIC database, and MFN principle, most favored nation principle. What does that mean? If I'm a WTO member and you are a WTO member, the tariff I impose on my most favored trading partner is the same tariff I have to impose on all other trading partners. I treat everybody in the same way. Now, the question has been put off the table by important WTO members, that includes the US and it includes the European Union, as to whether we need to rethink that principle. That question is shaking up the world of trade policymakers because it is shaking a fundamental principle of the WTO. How that discussion continues and how this will end will very much shape the trading system of the future, and the EU has an important role to play in shaping this future. I thank you for your attention and I look forward to the discussion.
Thank you, Marion. Just in passing, it's noteworthy that Hyun-Shin just now in the previous session said, it's so important, the value of commitment. If you can commit, then so many opportunities arise. But another way to rephrase what you just said is, of course, if you break that commitment to MFN, then you may think you get more discretion, but that narrows the kind of potential frontier for everyone in many ways. But anyway, over to Ralph.
Yeah, thank you very much for the invitation. It's great to be here, and I see we're already in the middle of the discussion about the main principles of the world trading system. Let me maybe say at the beginning, just to be clear, that I'm no longer at the WTO, and I also don't speak for the WTO, even though I don't plan to say anything that is particularly against the WTO. In my opening remarks, I really want to just make one point, one simple point, which is that Europe's role in this new global trade landscape, in my view, should be to prevent a damaged rules-based trading system from becoming a power-based one. World trade is facing its most serious institutional stress test in decades. What you see on the slide here is the trade-weighted average of the US tariff rate starting in January of last year all the way to pretty much now. And you see that it increased from below 3% at the beginning of last year to over 20% at some point last year, and has now settled at around 10%, more or less, in response to the Supreme Court decision. Now, there's two things I want to point out in relation to this slide. The first point is that it's really a tariff change of historic scale. So you have to go all the way back to the 1930s to see US tariffs of similar magnitude. The second thing I want to point, so it's clearly a shock of a large magnitude. The second point I want to make is that it's not just any country that is increasing tariffs here, but it's the United States, which in response to the tariff escalation in the 1930s played the leading role in founding the rules-based trading system and has also been the key steward of the rules-based trading system until now. So if you look at the source of the shock and the magnitude of the shock, you may have thought that this is a major problem for world trade, perhaps the beginning of the end of globalization. But then if you look at trade last year, actually trade has proved remarkably resilient. So what you see on this slide is merchandise trade growth by selected WTO regions. It's in current US dollar values. And the main point I just want to get across is that this is not a picture of deglobalization. So on the left, you see that world merchandise trade has grown by almost 7% in nominal terms. You see a bit of a pattern. I guess that's consistent with the tariffs. You see weaker growth in North America than on average, but clearly you don't see any deglobalization. Now, admittedly, the graph here is in nominal terms. If you looked at it in real terms, so if you looked at trade volumes and not trade values, it would look a little bit different, particularly for Europe. Particularly European exports would look worse. But even then, you're not going to come out of this thinking that we are deglobalizing in any significant way. So then the question is why, and there are a bunch of answers, but the main answer I want to emphasize is that despite everything that we say and read, the rules-based trading system has actually held up quite well. And that's really the central statistic I want you to remember for my, or the central point I want you to remember for my presentation. So on the left-hand side here, you see a graph that computes the share of world merchandise trade that is conducted directly under the MFN tariffs of the WTO, which Marion already explained what this is. And the way to read this is that now, despite all of the challenges that we are having, 72% of world merchandise trade continues to be conducted directly under the tariffs negotiated at the WTO. Then in yellow, what you see is that an additional 16% of world trade benefits from additional tariff reductions that go above and beyond the MFN tariffs that are granted in the context of preferential trade agreements, which are also part of the rules-based trading system. So that only 12% of world trade at the moment is really power-based, if you will, as kind of outside of the system. And I think this is so important because in trade policy, just as in macroeconomic policy, expectations can become self-fulfilling. You know, if we all convince ourselves that the rules-based trading system is dead, then of course we, or you as policymakers, I'm no longer in the policy world, then easily can also start saying, well, why should I play by the rules if nobody else is playing by the rules? And this can then become a dangerous self-fulfilling prophecy. On the right-hand side, you see, at least in part, what's in part the explanation of the story, which is that the US share in world merchandise imports is perhaps smaller than some people would have thought. So of all the imports in the world, around 14% go to the United States, and it's not a coincidence that the red pieces in both figures are somewhat of a similar magnitude. Now, of course, the rules-based trading system is not the only reason why trade has been resilient. Another important reason, interestingly, and we can talk about it in the discussion, has been AI. So AI investments are also heavily intensive in traded goods. So that has led to a boom in trade also in the United States, but that's a bit of a separate topic here. So now lastly, what does this mean for Europe? And what I would argue is that what this means for Europe, that Europe must choose stewardship over proliferation. So my sense is that Europe really has a special stake in the rules-based trading system because first, it is too open to prosper in a power-based world, but it's also too big to just watch and see what happens to the rules-based system. So therefore, I would argue that Europe should use its weight to defend the cooperative system on which it also depends. And concretely, this means leaning more often in the direction of stewardship choices and perhaps avoiding some proliferation risks. And what you see here are just some recent newspaper clippings. This is why it looks a little bit messy, just headlines from recent newspapers, which seem to suggest that Europe is still perhaps having this debate on maybe whether we want to be on the right side or the left side here. And I've organized this along 4 topics. The first topic is WTO reform. The second topic, so the second line, would be industrial policy or competitiveness. The third one is China, and then the global south. So let me just quickly walk you through this. So what I would advocate, starting in the first row, is that we should work, as Europeans, we should work towards strengthening the rules-based system through WTO reform rather than questioning the fundamental tenets of the GATT and the WTO. Second, I would argue that instead of adopting protectionist industrial policies, we should work on strengthening our competitiveness by integrating the single market for goods, for capital, for services, for digital services, and so on. I would argue that even though it's difficult, and I understand the challenges, we should try to find a cooperative solution with China rather than seeking escalating rhetoric, because China will also in the future be an incredibly important trading nation. And lastly, that we should, I believe, cooperatively engage the global south, for example, through agreements like Mercosur, and be a little bit more careful with regulatory measures that, let me say, test the goodwill of the global south. So just in conclusion then, the main points I was trying to make is that surging US tariffs are a stress test for world trade, but that yet world trade has proved remarkably resilient. The main reason, in my assessment, is that the rules-based trading system has been much more resilient than is often assumed, but this resilience should not be confused with robustness, and this is where Europe comes in. I believe that Europe must choose to be a steward of this rules-based trading system and prevent a damaged rules-based trading system from becoming a power-based one. Thank you very much.
And the final panel speaker is Denis.
For your invitation as well. So maybe I will speak from here, and I'll pick up where Ralph left, since you're basically putting an ask on the EU to be the custodian of the rules-based trading system. I would say yes, we are a custodian of the rules-based trading system. Will continue to be, perhaps with 2 caveats, is that in multilateral system we cannot be the only custodian of the world trading system. And we want to be a custodian of a reformed rules-based trading system, because reforms are necessary, and reform do not imply upending some of these fundamental principles on which this construct is built, which are indeed the MFN rule, as well as the principle of national treatment or non-discrimination in normal English. These are the 2 big shaping principles, but there is a case for reviewing the balance of rights and obligation, which has sedimented actually a very long time ago, without putting into question these 2 elements of mechanics of the WTO. Custodian, because yes, we do account for about 16% of this whole universe of trade in goods and services, which is the subject of the discussion in this panel, and it is in our well-considered interest to be a custodian of the system, because we are more open than some of the other big trade blocs. We're actually twice as open as the United States towards trade, and we do export a third of the total industrial production that is generated in the EU, and therefore we must have an industrial base that is competitive not just in the internal market, but has to be globally competitive. If not, it doesn't add up economically. And we need international trade because we need those outlets, and we need international trade for the industrial base because trade and investment integration, after all, is an engine of innovation diffusion. Interestingly, innovation is something that has not appeared very often in the debate on international trade, strangely, anymore. And that is true even if, in the face of certain external shocks or shocks to external trade, the internal market does serve as a cushion, in the sense that you can see it as a sort of one big regionalized network of production and trade. That's what the internal market for goods certainly represents. But we do probably have to navigate a changed landscape, and I would argue that there is perhaps in this here two issues. One is a relatively limited challenge. One is perhaps a slightly bigger, more structural challenge. The limited challenge is the challenge of volatility and unpredictability in global trade today, which is primarily driven by the decision by the United States to rebase its tariff structure at around 15% ad valorem. And that raises, of course, two questions for everybody. One is, how costly is this to the economy, and actually more importantly, to whom among the economic agents? And there I think the economic literature is fairly clear that it essentially is costly to the importing firms and consumers. And the second question is how transformative is that for global trade? And there I think the argument has to be that tariffs as such probably only affect the adjustment process at the margin, mostly reshuffling bilateral balances more than anything. They are a negative supply side shock for the economy. But in any case, and I think this is what you were showing, Ralph, this issue for the time being effectively only affects about 13-14% of that overall universe that we're talking about, which is global trade in goods and services. And in the face of that, the EU's policy has been and will continue to be to try to reduce as much as possible that instability in the transatlantic bilateral relationship. The second challenge is probably more significant. It's how much structural deep economic fragmentation or de-integration is there likely to be through the de-integration of existing global trade and investment networks. And there I think one can probably argue that there will be a certain set of pockets of decoupling, that decoupling will take place, probably in a zone which is that nexus around trade, emerging digital technologies, and national security, and where they interact, given the ubiquitous nature of some of the emerging digital tech in particular. That is not without consequences, of course, because it affects very deeply globally integrated sectors, semiconductors, microelectronics, where actually we see today the most elongated global supply chains. And there's a reasons for that, because there was an efficiency reason for that to develop. And that will be affected, no doubt. The question will be whether fragmentation will also affect data and data flows, because that has probably consequences, bigger consequences, not least because data is, of course, the engine behind one engine of more economic integration, more trade integration, which is the digitalization of trade, which against geopolitical shocks is actually pushing towards more integration. Where we believe from the EU side that we have to be extremely careful from a policy point of view is to avoid two things. One is the excessive securitization of industrial supply chains for pure geopolitical reasons. That's why we believe that one must be concerned about the expansion of trade restrictive measures, for example, export controls under the guise of security controls, when they start affecting a vast universe of, for example, input materials, such as critical raw materials, rare earth elements, insofar as these are actually connected primarily to purely civilian industrial supply chains. And creating in this area a system of managed trade to ensure a dominance and concentration is a problem. Similarly, and flowing from this, the weaponization of asymmetric dependencies or the practice of economic coercion is also a problem. It's a problem for economic reasons. It's a problem because it's also a problem in terms of international public law. Now, in the face of this, there is a need to reform global trade rules, probably for one or two fundamental reasons. One is that there's going to be inevitably more government intervention in the economy, and there are more industrial policies, and industrial policies are becoming much more important in terms of shaping global trade investment than classical trade measures at the border. And it has to do about, at the end of the day, who is going to capture the value added generated by sort of green and digital industrial transformation that every country is trying to engineer right now. So without a covenant, these kinds of industrial policies, if they're not coordinated, inevitably lead to more trade tensions. And then because indeed there is one player in particular which is creating a challenge for the world trading system at the moment, which is China, because it presents a sort of macro-industrial challenge in the sense that it is now contributing to this excessive concentration of trade that Marion was referring to, and in a way which is going to lead China tendentially to generate surpluses with the entirety of the world on all industrial goods. So at some point this becomes almost self-defeating vis-à-vis the fundamental principle of comparative advantage, on which, after all, trade liberalization is built. I will maybe just finish by saying that, so in the light of this, I think what Marion was saying, that the response today is to find a set of trade-related policies that balance this need for efficiency on one hand and resilience on the other hand, is indeed the principal challenge. From a European point of view, we think that there are ways to do this, first of all, in a targeted and proportionate way. And the only way to be targeted and proportionate is to be genuinely risk-based in the assessment of this balance between efficiency and resilience, and to avoid beggar-thy-neighbor policies by design, which is something that, of course, we are committed to. That de-risking, diversification, avoidance of over-concentration in international trade requires actually more trade, more active trade policies, more diversification, and this is why on the EU side we are maintaining an active agenda of negotiations of new trade integrative frameworks, the agreement with Mercosur being, of course, one of those examples. Thank you very much.
Thank you, Denis. I mean, I think we've heard you might say I've just heard 40 minutes of a really diverse set of topics, a really wide-ranging discussion. But there are, I think, a lot of common threads across the different contributions, which, you know, over the course of the remaining 35 minutes, I hope we can get to. Let me just pause to give the speakers a break. just for 1 second, just to explain a little bit what's going on at the ECB. So maybe at the ECB, one of the big projects in recent years, which mirrors what's going on in academia, also other policy organizations, is the staff have built a large global model with many countries, many sectors, and every input-output interconnection you can think of. I mean, and that reflects, if you like, some of the diverse, the issues we've heard today. So then when you ask an export restriction on some rare earth, absolutely tiny in world GDP, but then you can see how that cascades through the global system. And it's very important from our point of view, trying to connect all of this to the performance of the European economy, thinking about what's going on through final consumer goods, which of course matters, but also through intermediates. In the Young Economist competition, one of the papers is saying so much of productivity is locked into new capital goods. And that's where innovation takes place. So understanding it's inescapable. You do have to go granular in many ways when you take this on. So I'm going to give each of the panelists just a chance for further reflections, especially from hearing the other panelists. But maybe I'll add 2 extra dimensions to that. Is at the BIS annual conference on Friday, there was an interesting discussion. And one of the issues was you cannot really de-link international economic policy from domestic politics. And we know, and I think we heard a version of this already in this event, the beneficiaries of world trade are diffuse. Those who might suffer are very concentrated. So essentially, again, no matter where the outcome of whether it's the European Commission's thinking or the OECD's thinking, wherever it goes, how do you communicate, to domestic policymakers who in turn have to explain to their domestic audiences, how do you communicate this complicated balance that Denis just highlighted? So maybe again, Laura, just coming back to you, we've heard a lot now here, but in terms of whether you want to reinforce any points you made or just cross-comment on what you've heard.
No, so I just want to mention that the IDB, we remain committed to trade and regional integration. Latin America, we're all small open economies. To realize a lot of the gains, we need scale, and the only way to achieve scale for us is to trade. So we're committed to trade. I also want to mention that Brazil has 1/4 of the world reserves on rare earths. Again, look to Latin America to solve some of those problems.
Thank you. Marianne?
So just to repeat, as I mentioned before, definitely the participants to the export credit arrangement are looking to Latin America, and they look forward to helping, supporting more investment projects in that regions. In terms of the balance between resilience and efficiency, I think we face a different challenge here. Humans, when there's a new thing happening, we tend to go from one extreme to the other. So now it's resilience. How do we become resilient? We protect ourselves. That's a tendency that we have. And that would be the wrong thing to do. I fully agree with Laura, and I think with the other speakers here. Open markets bring a lot of benefits, including in terms of resilience. So please, let's find a balance between efficiency gains and a bigger attention to resilience. And last but not least, it is really urgent to come up with solutions to this, that there is an issue with the enforcement of the use of subsidies in the multilateral trading system has been known for 1/4 of a century. Since the Doha round started in 2021, a revision of the subsidies rules at the WTO was on the agenda. It's still on the agenda. No reform has happened. 25 years, that's a lot. The problems, the effects we see are too big. Either members now manage to get their act together and negotiate what matters at the WTO, or it may start to be too late for the WTO. And potentially, in order to negotiate something effective. We have to think out of the box and maybe to play a little bit with some of the fundamentals without throwing them fully away. There is a certain level of urgency.
Thank you. Ralph?
Well, the one point I would make is that I think we're making our lives a little bit too hard with the efficiency resilience trade-off. Of course, there is this trade-off, but clearly the worst solution is to make everything at home now, or to try to find rare earths now in Germany. This is, maybe you'll find some, but I don't think that's a very cost-effective way of doing it. And Marion pointed already to one obvious solution, which is diversification, which again gives you the outside options that you may need. But I would like to add one other consideration that I think has been completely forgotten, and it's this idea of interdependence, which interestingly as Europeans should be top of mind, because if you think of the history of European integration, it was about Germany and France trading because they were enemies. Yeah, it's exactly the opposite of today. And the idea was that if you create interdependence, you also create leverage. And I think we've forgotten that completely because, I mean, the entire discussion, even in this panel, is what are we dependent on? And then the solution is, well, let's get independent. But why don't we think, and what this means in practice, it means we invest in our weaknesses, yeah? Because typically there's a reason we import something. So why aren't we strategic, perhaps even with industrial policy, and say, well, where do we have leverage, and can we strengthen that? So that in case, if push comes to shove, and someone wants to weaponize our dependence on them, we have kind of a counter proposal to make, so to speak. I think that could go a long way in making this efficiency resilience trade-off much less bad than it seems.
Very good. Thank you, Denis.
Just maybe an additional point on this question of the trade-off between efficiency and resilience. The big challenge, of course, is that some of these issues, first of all, they don't lend themselves to easy fixes, notably to bilateral deals, because you do not negotiate disciplines on subsidies vis-à-vis one partner, because if you do it vis-à-vis the rest of the world. So you need, at some point, to go back to some sort of global trade framework, which requires, of course, a very intense appetite for international cooperation. But on these issues, it is necessary. And similarly, I think the risk today is that the need to find this new balance, to inject a dose of resilience or security within efficiency framework, is done on a purely unilateral basis. There are no rules of the game. There are no guardrails for this that are agreed. The existing guardrails, for example, the way in which the world trading system, the rules-based trading system, had previously integrated national security, are dysfunctional. We lived for several decades under the illusion that national security was an exception, actually. It's an exception in the GATT, a narrow exception within the world of integrated trade. Obviously, national security is not an exception.
I think that point is so fundamental. Let me also highlight, before going to the floor, someone raised here in the panel that essentially, there's a massive upcoming opportunity with digitization. So Richard Baldwin has emphasized that we could have a new wave of globalization, the trading opportunities coming from the ability to increase the tradability of services through digitalization. And for Europe, I mean, this is something, and indeed around the world. So it's not just the issue about protecting, you were saying, it's being the steward of the existing system, but that's also essentially creating the environment in which that potential gain can be captured. So let me see if people might have questions, and I will very naturally go to Shebnem, who runs this very important initiative at Brown University. So Shebnem.
Yes, thank you very much. Fantastic panel. And I would like to go back to what Phil said. So we started this work of Global Linkages Lab at Brown, going back very much to the global networks idea and bringing the input-output linkages, and also financial networks. So, and once you do that and you start thinking in networks, multi-layer networks, trade networks, production networks, and financial networks, you realize that another reason for resilience is global interdependence. Because you have to think in global general equilibrium. And you know, so exactly as you know, Ralph's saying, yes, rule-based system hold and trade resilience, and as Laura said, we are not deglobalization, deglobalizing, fully agree. But that's because of a structural feature of that global interdependent system. The system is so globally interdependent on each right now that even you want to, you just cannot take it back. And you are just going to create these inflationary impact, increased costs, you know, problems for macro stability. So it is really not a trade-off between resilience and efficiency, but it is the same network property seen from both sides. And that really brings me to my question now, especially to Ralph and Laura. Given that, you know, this, let's say, you know, our work goes to 2020. I mean, you know, Silvana has goals actually looking at resilience, Marion, much before to 2010. So it seems like academics never only focus on the cost and efficiency side. They understand the resilience issue and also from a macro central banker perspective. So why you think during the first Trump administration, when these issues realized, like, okay, we don't want to be dependent on China for rare earths, we want to diversify the critical minerals, why not invest in Brazil? And, you know, why WTO kind of, you know, didn't communicate this, that, like, it has been 10 years, right? And there was bipartisan support, both during the first Trump administration and then the Biden administration, like pushing tariffs, because tariffs is the worst thing you can do in this world. Pushing tariffs and try to create this, let's not be independent. So why the approach of diversification and investment in countries, you know, say, if you want to focus on rare earths, Brazil, have not happened 10 years ago? Thank you.
And maybe, Shevlin, for microphone efficiency, I'm going to organize by geography here. So Beata.
Thank you, Phil. Can we decouple the discussion about trade from the discussion about other European challenges, such as, for instance, high energy costs? Right? The price of natural gas in Europe is 5 times the price in the US. If we want to address this issue, we should really speed up green transition. But there is a tension between speeding up green transition through cheap imports of perhaps subsidized solar panels and wind turbines from China and our desire to preserve, let's say, the wind turbine industry in Europe. How should we be thinking about this trade-off?
Thank you. And if you just pass over to Martin.
So thanks very much for a very interesting panel. I want to come back to the most favored nation clause that some of you mentioned. Giving it up, it seems to be a case where we get into the law of the jungle, and the self-commitment that we had as large trading partners not to use our market power is over. So I would be very interested in your view on how you could adapt it or adjust it as it is discussed, and not getting into a spiral of deterioration and more and more protectionism around the world if it is given up.
Okay, thank you, Martin. So I'm going to let the panel respond, but just to set up the next round, the next question will go to Helen Ray over there, and then Joachim and Yanis in the front row. Okay, so please, Laura, if you...
So in the last one, for the most part, we're small open economies. And I do believe that the World Trade System, the WTO, was very beneficial for Latin America. We had fights against big countries in the WTO, and we got those big countries to change the rules. So, as I said, we remain committed to the trade system. I do think it has served us well. But let me now mention work that I have been doing with David Chor and Maggie Chen. We try to understand why there was a change in the US in terms of trade policy. The US has always been very supportive of free trade. And what we found is that there is an association between unfair practices, loss of jobs, national security, and China. Like, those items became bundled together. And they were not able to disassociate them, and thus the outcome was what we saw. As IDB, I cannot speak of our members, and the US is our member. But I do think there was some political angst there that was waiting to find a way out. It is likely that is some of the ways we allowed China to get into the world trading system. So I think the original thing, a different original thing, I think is more complicated. And in a way, this is a reaction to what's going on. But having said that, to the point that the US has remained engaged with the region, and FDI has remained very resilient in the region. So again, I don't think it has been necessarily substitutes. I think they have been complements. On the question of rare earths, it has become my party trick. I can now tell you a lot about rare earths. I have a paper on the event in Japan, and we do have a critical mineral initiative where we're trying to understand rare earths. They're not rare geologically, they're just very hard to mine. And to make it profitable is very expensive. We tend to think of minerals and metals as all of them being commodities, as for example, oil has been commoditized and copper. It turns out rare earth is not commoditized. It's sold by contract, the same way as lithium is sold by contract, and is very specialized, and this makes it very hard to achieve economies of scale. But as I said, this has become my party trick. I can tell you a lot. I've seen mines, videos of mining, so I've gone deep. On energy, I allow Europe to discuss. I'm going to just say that for us, well-diversified sources of energy is a strength. I think even when I was in Costa Rican government, we have a lot of hydro, sun, and wind. And our president, when I was in government, we have a president. Let me also tell you that Latin America, we elect women presidents constantly. We have in North, Central, and South America women presidents. I want to say this because that's another thing people have wrong. We do have women presidents, and we elect them all the time. When I was in government, we can go 100% electric renewable. Our president, women, did not want to shut down the one that we had in oil. She said, there might be a day where there's a cloud, we have no rain, and we have no wind. We cannot go without energy. And if a small open economy like Costa Rica had it very clear a long time ago, I think this is an important lesson. We cannot go without energy.
Thank you. Marion?
Let me start by thanking Laura for pointing out the greenness of Latin America. It's an important point to make, and also thank you for highlighting the role of gender in your continent. Also, when it comes just to trade agreements, the role of gender in trade agreements, Latin America is a front runner. Now back to the questions. I would like to answer to two. The green transition, indeed, there is a relationship with the trade discussion. When we released the MAGIC database in June, one of the messages was heavy subsidization in heavy industries and in green technologies. You see recently subsidization has very much shifted towards wind turbines. Solar panels has been subsidized for a long time. Also interesting, we are doing work now on how a combination of different so-called non-market policies and practices, another buzzword in the trade community, are being used, for instance, in the e-vehicle industry, where subsidization happens for steel, aluminium, and the car itself, and then export restrictions are used, for instance, for the raw materials and the rare earths that go into the battery. So yes, this is relevant, this discussion for the green transition, and Europe may not have its green transition, the speed of it, entirely under its control anymore. When it comes to how to avoid a spiral into protectionism, I would love to have the answer to this. And here I'm passing that answer to the academics in the room. My take to the current situation is that as a trade economist, I've moved away from general equilibrium thinking to game theory thinking. And I unfortunately only remember the basics of this. And the basics was that good equilibrium is not stable and that you move into this prisoner's dilemma. And I have the impression that I'm seeing this move happening right now, and I'm asking people around me, how do we get out of this? What do we need to do to trigger the negotiations, to get the action, to get back to a better equilibrium. That's what we need. If any of you has insights into this, how we have managed to do this in the past, for instance, please come to see me and let's talk after this session.
Very good. So, Ralph.
This couldn't have been a better stepping stone for what I was going to say. Because the academic literature is very clear, the principles of MFN and reciprocity are exactly what gets you out of this prisoner's dilemma. So let me just answer the MFN question. I don't think we can all answer all questions, even though they're all very good. I mean, for me, it would be I'm very clear, it would be a very bad idea now to give up MFN, or the domestic version, which would be national treatment. And there's economic reasons and there's pragmatic reasons. The economic reasons are also very simple. If you're my principal supplier of a particular good and I negotiate with you, we reduce our tariffs. If I don't do anything to my other trading partners, I put them at a disadvantage. So really you need this MFN to basically insulate outsiders from the deals we make as insiders. And this is not just hypothetical. You saw it actually now with the EU-US deal, which is not MFN. Then, of course, third countries start complaining. Then Brazil says, well, you haven't changed your tariffs against me, but you've changed your tariffs against the US. So relatively speaking, I'm now worse off. So you get this whole political dynamic. But then there's also pragmatic reasons. And again, I think the US experience is now a case in point. If you have different tariffs against every trading partner, I mean, think about the logistics at the border. You need to decide, where is this good from? What are the rules of origin? Is this really a Vietnamese good, or is this maybe a Chinese good? You need to certify. It becomes a huge nightmare. So both from a fundamental economic perspective, but also simply from a bureaucratic, or let me say non-bureaucratic perspective, I think it really doesn't make sense to give this up. And it's literally Article 1 of the GATT that I think has been the foundation of the great wave of globalization that we've been seeing since 1947.
Thank you, Ralph. Denis?
Well, perhaps I can try to address the question on why has diversification not taken place in certain areas, for example, on this question of critical minerals and rare earth elements. I think there it's a question of, what's diagnostic? Well, today there is indeed real market dominance because we and many others rely on imports from China for the processed minerals and materials concerned, sometimes to the tune of 85% of the totality of the consumption. And that creates a problem because there is market dominance. So there is a big uncertainty in terms of the price and the offtake. And therefore, it is likely that the solution will come from finding a way to create lead markets in these goods by insulating them somehow from Chinese supply and reducing that level of dependency from those levels to somewhere around 50%, where the problem of price dominance simply is not there anymore. So it's very strange because there's a government failure which we'll need to correct through some sort of a market of a government intervention now, clearly, to recreate proper market conditions. And that is what is happening, and that's what is probably going to happen in terms of now policy initiatives to perhaps try to do that, which will involve a combination of government intervention, whether it's strategic stockpiling, whether it is creating price floors, and if it is creating price floor, there's a big question of how you create a price floor, which then does not lead to excessive costs to the competitiveness of the downstream, which I think was your point in terms of the transition, and this affects actually the green transition. The point is that there is a balance that needs to be struck between not denting into the competitiveness of all downstream industries and at the same time not having single choke points at particular points in the supply chain. And the cost of insurance against choke points is there. There is a cost. And the big question will be, who bears the cost in the economy?
Thank you, Denis. So Hélène?
Thanks a lot. within the G7 discussions, so which were about global imbalances, there were also discussions about sectoral imbalances, which are a different issue, but which are also very obviously important for policymakers and for the public. And has always been issues with trade surges and the political economy of trade surges when there are very rapid import surges in specific industries that may wipe out entire industrial ecosystem. And because of that, the WTO and the GATT were constructed indeed with safety valves, because it was really understood that if we want to maintain a rule-based international trade, we do need some safety valves, some breathing space, which are temporary types of measures in order to give time for people, societies to adapt. Now, these safety valves, which are, the GATT Article 19, etc., have become more cumbersome to use. They concern narrow products. They have a lot of legal, lengthy processes, etc. So, is there any prospect that instead of, trying to destroy the underlying structure, the MFN, etc., is there any prospect of making these clauses a bit more pragmatic, like easier to use? And that would apply also to the national security clause of the GATT, Article 21. So is there any prospect that there could be some concrete, reasonable, pragmatic adaptation of these clauses in the near term in order to address these issues, which are legitimate issues?
Okay, thank you, Helen. So if you can have a microphone in the front row. First Yanis, then Joachim, and then I'll ask Pierre.
Many thanks to the four panelists for this discussion, which is very crucial for the welfare of the world. In my view, what I have taken today is that the US have risen tariffs from less than 3% before to more than 10% now. China is restricting exports. So this is bad for both of them and for the rest of the world. And don't be misled. The fact that, Ralph, you said that trade is resilient, this is because of the AI boom and the fiscal expansion, which might not be sustainable. So growth could be higher and inflation could be lower for everybody, including the US, including China, including the rest of the world. Europe and the rest of the world is in the middle of these protectionist tendencies. So definitely from proliferation or stewardship, I would choose stewardship for Europe, and more, I would say that Europe is in a position to take the initiative to convince the other trade partners that it is in the benefit for everybody, including them, mostly the US and China, and the rest of the world, that we can move from a lose-lose situation to a win-win situation, from a zero-sum game to a cooperative game. Thank you.
Okay, thank you, Joachim. And if you just pass the mic to Joachim. Yeah.
Yeah, thank you very much for this very interesting trade discussion. It gives me the opportunity to repeat my plea related to the completion of the single market. I think the most important trading partner of European countries is Europe itself. So we are in the driver's seat. We can do a lot to improve here, and it's not just the capital market union. So there are so many other things. We are still in a very fragmented environment in Europe. Is it the energy market? But nevertheless, I guess this lesson, I believe, is more and more understood, and I see good developments in Brussels. And then I have to come back to the white elephant in the room. This is China. When we are discussing trade, we have to discuss China. Take Germany, my country. The last time when we had a balanced trade with China was in 2007. Since then, the trade deficit went up last year to a record high level, close to 90 billion euros. So there was said, okay, we have to get with them into a kind of a cooperative solution. Well, when you want to get there, you need two partners to really show this willingness for cooperation. It takes two to tango. So what I would like to ask you is, do you see a feasible, realistic way to get there? Or what I see is at the moment that China is playing, let me say, the cards in a way that it takes a long time on the European side to coordinate things, and they're doing their stuff. And at the end, we need to protect our core industries. This is of utmost importance for our people in Europe. So it is a very complicated situation, but time is our ultimate constraint. It takes too long till we come to a solution with China. But maybe you have new ideas. Yeah. I do not know.
So if you can pass the microphone to Pierre once over there, and then I'll finally ask Ricardo Reis after that.
Yeah, I guess my question goes in the same direction as the comments made by Joachim. We are very good as economists at defining first best solutions. When we have to combine first best with something else, then it becomes difficult. So two considerations on this front. One, can we really abstract from the fact that China is supporting Russia in its war against Ukraine? I mean, can we really abstract diplomatic considerations from trade considerations? The other one is, can you be half pregnant in the sense of following rules, but then not with everybody? I mean, the US and China are transactional. They are not following rules. It's about power. So can you devise a trade system where with some partners it's about power and finding a balanced deal, to use the expression of a US president, and then you would be rule-based for the rest. But I don't think it's possible just to dream about something that can be only rules-based. That's past. That's not the. I mean, we can dream of it, but that's not the case anymore.
Okay, thank you, Pierre. And then finally, Ricardo.
Thank you. A comment and a question. The comment, following a little bit on something Ralph said, and relative to the other panels, is that the gains from trade come from specialization. The two are tied to each other. You cannot have gains from trade unless you specialize. So when I hear a lot of talk about diversification, and I understand where it comes from, to note that it's not really, I think, diversification that one wants. One wants is flexibility. One wants is flexibility to shift from buying everything from the cheapest possible provider to, when they become less cheap, to then shift as quickly as possible to the now new cheapest provider, cheapest or more sufficient, or whatever one wants. So insofar as the discussion on diversification often is tied to industrial policies and introducing more rigidities into the European market, the right answer is the other way around. What we want is to introduce more flexibility into the European markets in order for, when the cheapest stops being the cheapest, we can shift who we're purchasing from and therefore not become dependent on them. And that's true both in game theory and in general equilibrium. But it's flexibility, I think, is the right word, not really diversification. Question. In a world with all of the changes that you have been discussing, in terms of trade patterns that will emerge from the negotiations or not, that is a world where, with those trade patterns, the key equilibrating force is going to have to be real exchange rates moving around. At a very basic level, if we have the US persistently running very large current account deficits and China running very large current account surpluses, it's somewhat inevitable that the euro as a real exchange rate has to depreciate relative to the US and appreciate relative to the Chinese currency, the renminbi. Do you see from this, for this audience of central bankers with that, will that come with volatility in nominal exchange rates? Do you think the international monetary system is ready to absorb that? Or will we see instead price levels having to the adjustment, which would then pose a very big challenge for everyone here in this room, because with that volatility in real exchange rates, we're going to have inflation and deflation spurts coming. Thank you.
Okay, thank you, Ricardo. Ricardo's asked a very big question, which I don't think we're going to answer in the limited time we have available. But I do want to give each panelist just a little short response time. So whether from what you just heard or any other type of closing comment, I'll go now in this order. So Denis.
Well, I can only maybe concentrate on one point Elena made. There's a need for contingency protection at this juncture, but the contingency protection tools do exist, indeed. The safeguard instrument is precisely what you described. I think it has flexibility in the sense that it is not too product specific, but it has one big downside, which is that it is supposed to be applied erga omnes. Whereas in some cases, of course, the surge is coming primarily from one origin. And that is an issue. But there are two different issues, and the second one is even more complicated than the contingency protection, is that there is an issue about the surge, and then there is an issue about the excessive concentration and dependency that this creates, and the need to structurally reduce and diversify. And that is more complicated because it is more structural than anything that can be achieved through, let's say, traditional trade contingency tools. So there are more limitations and I think more challenges as well, simply beyond the phenomenon of surge.
Okay, thank you, Ralph.
Yeah, at the beginning of the session, you were almost excited about the session to end on time. So let me also, in that spirit, be very quick. And just talk about, just take the China question, maybe fold in the imbalances a little bit. So I think as Europeans, we have to be a little bit careful to complain too loudly about global imbalances, of course. Also, from the perspective of my home country, I'm German, so I think I can be a bit tougher there. Like at the beginning of the 2000s, I believe every third car in China was a Volkswagen. So I think we also need to keep that history in mind a little bit. So what do? I think first we need to do our homework, and I very much subscribe to Governor Nagel's plea for to expand the single market. I think that's the obvious thing. But I think we've also made some policy choices in the past that were consequential, maybe a bit controversial, but if you prohibit your comparative advantage technology, for example, the internal combustion engine, I think it's, of course, this is not going to be good news for your car industry. But then beside these kind of obvious points, what can we do now immediately? And I think what Hélène said, the WTO has safeguard measures that we can take and should take. I have no problem with that, and perhaps we can make it a little bit more simply, make it a little bit simpler. But of course, we also need WTO reform. I think it's also very clear that the Chinese model is not really captured well in the WTO subsidy agreements. So it's not that they're not following the rules, it's just that the rules are not really suitable to the case. So clearly, reform is needed.
Thank you, Marion.
For the flexibility, our supply chain resilience review very much focused on the term agility, and so that's close to this. But we realized that there are limits to the pure flexibility argument, including because for some areas you need bulk investments with long-term effects, like investments in mining projects. Coming back to the rules. And I come back to game theory. If I remember correctly, these MFN rules, they are there to bind the big players, because it's the big players who have attempted to move into the prisoner's dilemma. Now, the big players are definitely China and the United States. And my guess is that at some stage, they will want to get back to rules like the ones we currently have, different, but they will want to get back to a rules-based trading system and to the WTO. The question is, how long will it take and how much damage is going to be done? And another question is, to which extent other big players or middle powers, as some call it, are going to be part of the design of that new rules-based system? And what questions that will be answered is to which extent just revisiting the safeguards that exist is enough, or more fundamental changes will be needed.
Very quickly, because we're really over time, in terms of the escape clauses that Helen mentioned, I want to remind that agriculture was excluded from the beginning, and then it became an interest group. So I do think we need to keep that in mind. And on your comment from Tango, is from Latin America. It's beautiful Argentina, and I'll then end there.
Okay. Thank you very much. So what I'm taking away from this is the stakes are really high. So lots of issues have been identified, and if we get it wrong, if there's more fragmentation than necessary, I think from our point of view, that spills over into investment frictions, technology frictions, and monetary frictions. So I'd like to thank the panelists who are so involved in this debate, and I hope you can join me in looking through this small deviation from the end of panel target. And I'll hand back to Claire.
Thank you, Philip. I think we can forgive you a few minutes, but please be back in the room at 2 p.m. sharp after lunch, which will be served downstairs. Then we're going to have our policy panel, which promises to be, as always, one of the session highlights. Thanks very much. Cheers.
Europe is navigating an increasingly uncertain economic environment, much of it shaped by forces beyond our borders. These forces test our growth model, our resilience, and our stability. At the same time, new technologies are reshaping our economies. Innovation, not to mention AI, is becoming central to global growth. These are the main questions we will address at the ECB Forum in Sintra. Policymakers, central bankers, and leading academics will come together to discuss how Europe can shape its future through innovation, growth, and stability.
Welcome back. The challenges we have been discussing over the past couple of days ultimately land on the desks of central bank heads. The members of our next panel must translate analysis into decisions that affect hundreds of millions of people. I am delighted to welcome to the stage Andrew Bailey, Governor of the Bank of England, Tiff Macklem, Head of the Bank of Canada, Christine Lagarde, President of the European Central Bank, and Kevin Walsh, Chair of the Board of Governors of the Federal Reserve. The panel will be expertly moderated by Sarah Eisen, anchor at CNBC. Sarah, over to you.
Thank you. Thank you very much. And thank you to President Lagarde and to the ECB for having me back here. It's an amazing tradition and one of the highlights of my year and my career, and way more fun than watching you guys on your irrespective press conferences. So this is going to be fun. And I'm excited because I'm hoping we can have a good debate about divergence in policy and approaches. And maybe with that, President Lagarde, I'll kick it off with you because you're the only one up here to have raised interest rates in response to the Middle East oil shock. Are you going to do it again? This year? Sorry. No, why did you do that?
Well, we did it because we had the perfect monetary policy circumstances to do so. And, when you have your inflation outlook up, your core inflation up, when you have the underlying inflation indicating that it's also trending up as well, and that you're only going back to your 2% target at the end of 28, with a number of things happening in our inflation outlook, which includes, the market expectations in particular. You have the obvious decision, and it was so obvious that we had a unanimity decision within the board of the governing council.
But seriously, how will you decide whether you keep going? Because you're still above target.
What we decided to do is way back to give up on forward guidance, okay? And personally, and I've said that publicly, if I have one regret, it's to have felt bound and compelled by forward guidance. So I think what we do is now also informing market participants, informing financial experts from all walks of life about how we come to our monetary policy stance. And I have called it not forward guidance, but framework guidance, so that those interested in how we come up to a particular decision appreciate what we take into account, what intellectual process we go through, what indicators we are particularly attentive to, so that, of course, they have to do a little bit more work themselves. It's not forward guidance blindly, and you just assume that it's going to be what had been calibrated as forward guidance. They will have to do a bit of homework. They will have to look at the indicators that we're attentive to. They will have to appreciate our intellectual process and what we are especially attentive to. And that includes, if I go through what we did on the 11th of June, we looked at the inflation outlook, taking into account all the latest economic and financial data, with risks part of our assessment as well. And that's, recent development, as you know. We looked at underlying inflation, various set of indicators, and we looked at the transmission of monetary policy. So it's taking all that into account in the context of a supply shock that led us to the decision that we made.
Speaking of not liking forward guidance, which is going to make this job so much harder for me, this panel, Chairman Warsh, we have inflation in the US that is higher than Europe's and farther away from our target. So why are we not raising interest rates?
I was hoping you were asking me about forward guidance.
We'll get there. Because you have so much to say there too, right?
So we have found common cause. It's what President Lagarde said. I liked her when we met 20 years ago when she was finance minister. After that answer, I love her. Reform does not stop at the water's edge. What I found most exhilarating about the last 2 days here is the kind of discussions that we've begun at the Federal Reserve has a lot of people at this conference open-minded, keen to think anew about the conduct of monetary policy. And President Lagarde's answer on forward guidance, I couldn't have said it better myself. We're going to chart a new course so that we can make better decisions and do the right thing. And so my few days here have been incredibly rewarding on that. On the broad conduct of policy, at my press conference, I said, I'm not going to give forward guidance because we're meeting in 6 weeks, but I have an update for you. We're meeting in 4 weeks.
Helpful. So is July on the table for a rate hike?
So Sarah is trying to get me to break this rule. She's going to fail. There's a lot of data that we received in that meeting. I see many of my FOMC colleagues here in Sintra. I take their views very seriously. I want us to have a good family fight when we meet in 4 weeks. There's a lot of late-breaking news on a series of these things. And when we get into that room and shut the door, we're going to have a good debate. But I don't have much more for you than that.
Okay, we'll get back to that. I have more questions for you. Governor Bailey, you did not raise interest rates, even though your inflation is above target, but there are members of your committee that want to raise interest rates. So why are you holding back?
So, I mean, like Kevin and Christine, you know, we all spend a great deal of time looking at the substance of the evidence. And I think an important piece of the substance of the evidence for us is that we've got a softening economy. So we're seeing a softening labour market, we're seeing some softening of activity. Yeah, we think we've got a bit of an output gap opening up, and we had that before the hostility broke out in the Gulf. So that's the contextual setting. I mean, because we're very focused on the risks of pass-through of the energy prices to the indirect effects and things like food prices and the second round effects. And we don't obviously want it to become embedded. It is very frustrating. I was very much of the view that we were going to have inflation back at the 2.0 targets, in the late spring. Everything I've seen actually since tends to confirm me in that previous view. It's obviously not there because of the effects in the Gulf. But the decision not to raise rates for me was based on, reading, the evidence of a softening economy. And then a second thing, and this is probably where we're in a little bit of a different position from the ECB to start with, because it's the sort of the adage, where you get to depends on where you start. There was an expectation that we would cut rates this year. That's not unreasonable in the context of the softening economy. Yeah, that was off the table in March, and it's off the table at the moment. So, that was the context for me that I think we had some time, because by taking that sort of, in a sense, that loosening off the table, the mortgage rate went up 1%. So you can argue that we've actually tightened policy in the period since the conflict broke out. But like Kevin and Christine, we review it every meeting. So we've got a meeting coming up at the end of July, and we will be looking at all the evidence again then. So we return to it.
Yeah, the weakening economy, though, it sounds like are you more worried about that than the higher inflation?
Well, I'm not going to give you any prediction as to what we will do. I think, obviously, the thing that has happened is that energy prices have come down quite substantially. They're still a bit above where they were pre-conflict, but they've come down. But the other thing you have to be a bit careful with in the UK is that we have a delayed reaction mechanism to energy prices because of the way our household energy price cap system works. So I always say, it's appropriate at the moment to borrow a soccer analogy. I'm afraid we always look a bit better in the first half than we do in the second half.
I'm proud that you used the word soccer. Now that the World Cup is in the US, everyone's talking soccer. Governor Macklem, your inflation rate for May was 3.2%. It was above your range for the first time in a long time, but you have not really spoken about raising interest rates. Are you comfortable where you are?
Well, we left our policy rate unchanged last time, so yes, I guess we're comfortable where we are.
Look, on the...
Going forward without forward guidance.
No forward guidance. What's interesting is we're all facing pretty similar shocks, but we all start from slightly different places, and we have different proximities or different exposures to these shocks. And the benefit of our frameworks with flexible exchange rates is we can direct policy for what we need in our country. So yeah, you're going to see some differences. In Canada, like the UK, the economy's soft. Economy's growing, but it's been weak. There's excess supply. The labor market, there's some slack in the labor market. But yes, inflation is clearly above the target, 3.2% in May. That's a dilemma for monetary policy. If we raise rates to pull inflation down, it's going to weaken the economy further. And if inflation comes down quickly, we're going to regret that we did that. On the other hand, if we cut rates, support growth, there's a risk that the rise of inflation becomes more persistent. So, when we looked at it, we're sort of on the, we think, our range for neutral is 225 to 325 or 225. So we're kind of at the bottom end of our neutral range, providing a little bit of support, but we think it's about the right level to keep inflation contained. The other thing I would say, though, is, and this gets a bit back to your forward guidance question, we got to be humble. There's a lot of uncertainty out there. Those risks could shift quickly. And the other part of our message is, if the situation changes, we're prepared to take action.
Do you think, Chairman Warsh, that the inflationary spark that everyone's seeing and feeling is a temporary phenomenon as a result of the rise of energy prices, which have already started reversing pretty sharply?
Does temporary sound like transitory? Is that what you were trying to sneak in?
Yes. Is it transitory?
So I'll build on what Governor Macklin just said. By the way, the four of us all served together in the global financial crisis in different roles. So I would say for us to be back on this stage in this circumstance is great. And they've been incredibly warm to me. President Lagarde has sort of welcomed and encouraged these sorts of new ideas that we've talked about at the Federal Reserve on these series of task forces. And Sarah, my hope is that the results of these can be a public good. If we make progress in thinking about the effect of productivity, the effect of data, new inflation frameworks, this is something we can all borrow and use from. The other thing I'll add is that monetary policy spills over from one of our economies to the other, and it spills back. I think the way Governor Macklin said it right, which is we're all being hit by a series of shocks. In the US, the AI shock is leading to a boom in capital expenditures. We see that first and foremost in demand, but I'm confident we're going to see it in supply at some point. So we're spending most of our time trying to monitor those developments.
Is it inflationary?
Well, in the near term, we can observe it on the demand side, but it's up to the central bank to decide whether it's inflationary.
That's why I'm asking.
Whether, in fact, it finds its way into a broader set of goods. I don't have any news for you on that, but I would certainly rather be in a position where we have two things, where we recommit, the way I know my colleagues have, to deliver price stability. And the other piece that I'll take note of, which shows some difference, I think, among our nations, is the AI boom is showing itself first and very prominently in the United States. I'd certainly rather have this problem, where we have massive capital expenditures, instead of thinking years back where we had financial engineering, where we had companies that weren't able to deliver profits, so they would do shareholder buybacks. Well, right now they're investing in the future because their expectation is the supply side of the economy will expand. And if it does, that has huge implications for monetary policy. But again, I'm not going to make a judgment now. We'll meet again in 4 weeks. But this is as exciting a time and also as a consequential a time to be a central banker that I can think of at any point, maybe outside of a crisis in my adult lifetime.
President Lagarde, how do you...
Can I pick up on a point that my friend Kevin made? It's the speed at which things change, and that is clearly accelerated by AI. And I think in that context, we have to be open to new measurements, new ways of thinking, new tools that help us and assist in making the right decisions. So I think in that context, the use of scenarios, for instance, that we have now really nail down with milder, severe, and adverse scenario to make sure that our decisions, are solid and robust across scenarios. The fact that we're incorporating risk into our assessment of inflation. And I think risks, by the way, that we have to the upside on inflation and to the downside of growth are probably more broadly balanced than they were a few weeks ago as a result of what we're seeing, which happens at speed. If you look at how fast the price of oil, spot price granted, has moved down, $72 a barrel now, when it was 120 back in March. These are changes that are just so accelerated that we have to be prepared to measure differently and more accurately using AI, for instance.
How do you make sure Europe doesn't get left behind on AI? I know it's not necessarily the job of the central banker.
It's not the central bank governor's question in a way.
I know you probably have thoughts on it.
No, I'll tell you something. One, I think that we have to consider that as a transformational technology breakthrough and diffusion and material technology. It needs to be analyzed from our perspective, both in terms of how much capex is going in that particular domain, what impact it will have, how fast will it develop, how will it diffuse, how will we reorganize the way in which we conduct work, including at our central banks, by the way, to really appreciate what impact it will have on productivity. But if it delivers the productivity expectation that we have, then it is going to be a radical change going forward. And we need to, of course, from our perspective as central bankers, we need to measure the disinflationary, inflationary impact it will have over the course of time. And it might be disinflationary first and inflationary second, or probably more so the other way around. But it all needs to take into account. Now, I take your point about Europe lagging behind in terms of investment and the frontier companies that are leading the game at the moment. But I think that we are all sort of hostage to each other, if I may say, because we need those frontier companies, but they need the market. When you represent 25% of the revenues of many of those hyperscalers, we need each other. We are in this game together. At which end of the spectrum, at which set of the supply chain to be determined, and there will be healthy competition, I'm sure. But we depend on each other. We can't dispense of them, and they can't dispense of the revenue source that we constitute. So we're in this together. That's my personal view.
Governor Macklem, how's it impacting Canada? Do you get the tailwind from the boom in the US, or are you still dealing with too big of a headwinds from trade, for instance?
Well, look, trade does continue to be a headwind. I mentioned the economy is soft. You certainly see the impact of U.S. tariffs on our exports. I think, coming back to investment, I think we get both some tailwind, but we also get a lot of competitive pressure from the U.S. The U.S. is investing in a very big way, and our economies are very integrated. We have a very integrated business model in North America. That's why trade uncertainty is impacting Canada. It also means, though, Canadian firms are going to have to be competitive. I mean, what you see on AI, it's very interesting talking to companies. So, you survey companies, you ask them, are you using AI? Yeah, like almost everybody's using AI. But then you say, okay, have you, materially changed the whole production process and made it embedded AI? That's a much smaller number. That's something like 10-15% depending. So it does show that there's a lot of potential there. Whether it's inflationary or disinflationary, I think looking out ultimately, I mean, there's so many good reasons why this is a general purpose technology. And one of the things I picked up over the last couple of days is, well, actually, it could be even bigger than that. If it actually accelerates the process of innovation, of discovery itself, it could be even bigger. But when exactly that arrives, when those disinflationary kick in, I think is a very open question. That's another one of those things we need to be humble about. In the near term, we are starting to see some pressures. You can see it, you mentioned our May CPI number. If you look at computers, up 10%. How's that going to feed through the supply chain? I mean, those are the sort of things that we're going to need to keep an eye on.
Yeah, memory chips are a big deal. There's the inflation question, Governor Bailey, there's also the jobs question. And I know it's early and we don't exactly know, but do you think of AI at this point as a job killer or job creator?
Well, I think the jury's out on that question. I mean, if you look at look at history, and you look at, I mean, Tiff's just been referring to general purpose technology innovation, and you've seen waves of general purpose technology innovation over history. And they've actually had different patterns in terms of their impact on employment. So you can't generalize to start with. You know, there are some channels which will create jobs. There are channels which will destroy jobs. There will be channels which will substitute jobs. I mean, two things matter here. One is what the mix of those channels is, and I say it has differed. Now, I do think, I mean, this is not a central bank point, this is much more of a broader public policy point. I do think we have choices in terms of public policy, you know, mixes that we adopt on that front, particularly in things like skills and training. And the second point I would make is, because again, this comes strongly through from looking at the past, is that the length of time it takes these effects to come through, and you know, I said there's more than one labour market effect, the length of time it takes for each of those effects to come through, and therefore what the mix will be over time differs over time. Now again, you know, we can have choices there in broad public policy terms and in how economies operate. So it's very important to look at that, but I wouldn't generalise. I mean, we're certainly, I mean, so far, you know, when I go around the country talking to businesses, yes, there's a lot of talk about it. I think a lot of businesses are using it. I mean, we're using it at the Bank of England. I would say we're still really in the experimentation phase, actually. And that's fine. I mean, that's what you'd understand. And the consequence of that is that you don't, certainly in the UK, I would say we don't see it strongly in the overall economy-wide data, but that doesn't surprise me. I think it's too early for that.
Chair Warsh, opinion on jobs?
So I'll jump in on that. First, I'll say this is one of the central questions that all of us have for our day jobs in evaluating output, employment, and inflation. These are big questions in part because the rate of change of improvement in these models is moving at an exponential level. This is hyper Moore's law stuff. And so while we might see business surveys that say no big deal, my speculation is 6 months from now, the surveys will be saying quite the opposite. The United States is likely to be a big winner over the medium term in this, but I don't say this from a parochial perspective. The US is not afraid of productivity-led economic growth, but we don't view the economics of this as zero sum. We aren't rooting for another country to fail. We're rooting for economic growth to be broad-based. That's good for the United States. It'll make all of our jobs easier. On your question of jobs, I mean, I will go back to good Econ 1. It's called the lump of labor fallacy for a reason. Who knew when the internet was born that the internet was going to create 1.5 million jobs as Uber drivers? We are in the first or second inning of this revolution. This is a big paradigm shift, both for the conduct of our policy and for our economies. I think the jobs will be greater, prosperity will be stronger. The question, as one of my colleagues raised, is timing, and we have to take that timing very seriously. We have, at least in the United States, a dual mandate, and we have to deliver both on the employment side and on the stable price side. So we'll be monitoring the speed of it. But if you wanted me to sound like a pessimist and a doomer on this, I'm afraid I'm not there.
If I could just come back on one other point on this whole area. I mean, the other big issue is financial stability. And you know, this is a very big, you know, a big development in terms of frontier AI. And what we do need to see, and I think this is pressing now, is that you know, we work together to have, you know, solid and robust arrangements for introducing these models so that we can take risks out as best we can where they are created, but I mean, they're always there, but they're brought to the surface, if you like, by these models. That is a very pressing issue that I think we have stronger coordination of that process.
President Lagarde.
And on that vein, I completely agree with Andrew on that, but I celebrate the fact that apparently tomorrow, the US and the EU authorities are going to get together and sit down and decide the terms under this will best be deployed for the safety of all of us. So that's a really good development.
I did want to bring it back to economic growth for a moment. President Lagarde, because, and I've asked you this for a few years in a row now, and you've always pushed back and have been right.
Okay, I'll push back again.
The stagflation question, and whether Europe is facing stagflation.
Okay, well, then I'll repeat what I've said before. Stagflation is a concept of the 70s in circumstances that are not replicated those days. We are currently at almost lowest historical levels of unemployment. Employment participation continues growing. There will be different jobs to your previous questions, but employment is continuing to grow.
But growth is weak.
And we are taking all the right steps to make sure that we have price stability. We're not going to let inflation run, out, or the genius get out of the bottle and inflation move up. We will take the necessary steps, and we have.
Yeah, I mean, the employment story has been a positive one for Europe, for the US as well. I mean, we've seen a really remarkably resilient labor market. Chairman Warsh, how do you interpret the recent data points on the labor side of your mandate?
So when we met 2 weeks ago, I think the way we as a committee described the labor side of the mandate is we said labor markets are steady. We said the demand side of the economy was solid. And we said the supply side of the economy, especially CapEx and productivity, again, this is before we see the fruits of AI, we said that was strong. I don't want to sound like a Wall Street newsletter and update that with recent events because we follow trends. And I'll reinforce something that President Lagarde just said. We're all in the price stability business. That might not be our only business, but if there was a common thing I heard over the last couple of days, it was open-mindedness on these questions of AI, open-mindedness on productivity. But we've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
So the market was right to interpret your first news conference as hawkish.
Nice try.
Yeah, I'm not. I've just gotten advice from the senior statesman on this group not to do that. But I'll say this: expectations of inflation over the first 4 months, first 4 weeks of this period, they've come down. Inflation risks have come down. Again, in our business, we don't want to overdetermine things. But if there were people in household or the business sector and the financial markets who thought that this central bank was going to be comfortable with an inflation objective above 2%, well, I guess they'd be disappointed. We're going to deliver price stability in the US. That's what this committee has signed up to do. And our objective is to do that. The tactics, the strategy, and the rest, that's still to come.
No matter what the president wants.
We've been an independent central bank for a very long time. We're going to be an independent central bank at this moment, and you're going to see no changes on that.
So is anybody...
Can I come back to the stagflation point? Because I just want to double down on Christine. I mean, stagflation, it's double-digit inflation, double-digit unemployment. And the other thing, getting back to what Kevin was just saying, it's unanchored inflation expectations. That was the fundamental problem in the 1970s.
We don't have that.
And the only way we got out of it was we had to have a big recession to re-anchor expectations. If that happens, we have fundamentally failed to do our jobs. So yes, we have a period, Canada, the economy's weak, unemployment's a little bit, it's high, it's 6.6. Inflation's 3.2. Those are not double-digit numbers, and that inflation isn't not going to be persistent. Inflation expectations are well anchored. We're going to keep them well anchored. So this whole word of stagflation, it doesn't apply to the situation we have today. You got to distinguish between a rise in unemployment and inflation and stagflation. They're not the same thing.
Right. Some people just think of it as slower growth and higher inflation, but clearly. That's not where you guys...
It's a much more loaded word than that.
Yeah.
Governor Bailey, on this topic of forward guidance, we make light of it, but it is a bit of a change, a departure from where we've seen central banks in recent years. You kind of got rid of forward guidance in 2021. You said you did. And how do we determine the difference between a reaction function and forward guidance?
Well, look, I think we have to sort of tread carefully through this debate, not least because of the question you just asked. But I mean, almost anything we say, of course, can attempt to be interpreted as forward guidance. And the second thing I would observe is that, of course, all of us are making policy which is going to have effect in the future. So we sort of start with that position. I mean, I think where forward guidance has been very difficult, and therefore I'm in a very similar place to my colleagues, is that you can get locked into it very easily. You know, I've said a number of times in our committee, it's much easier to put it in place than it is to take it away. And therefore, before you actually go and put it in place, just think about, you know, what we're going to have to deal with as time goes by, because you know, it becomes quite problematic after a while. It overstays its welcome. So, you know, I'm also very cautious. Now, but I recognize that, you know, anything we say about the outlook for the economy can be interpreted as a view of the future. And of course, that, you know, we have to sort of, in a sense, do that. But I think we have to be very careful about, you know, getting tied into views on where rates are going to go. That's the thing that is much more problematic.
But isn't it important, Chairman Walsh, to give the market a sense of how you're thinking about policy? You don't have to give them a pre-commitment, but the whole reaction function, how you think of how you're going to make policy.
So I think the most important thing we can do is to get policy right. If our communications tools, if our models, if the way we've been playing things makes it harder for us to go into these meetings, have a family fight with our colleagues, and make the best decision in pursuit of our mandates, if that's an obstacle, we should get rid of it. It is said in recent weeks, well, we need to know more about your reaction function. If I look at trigger pullers, people that are making decisions in the bond market, in a range of markets, volatility is not up, it's down. Yields aren't up, they're down. Inflation expectations are down. So I hear this, that as if people don't understand. I think they actually understand quite well. I feel incredible comfort that I'm not sure I had internalized, that there is a willingness by my colleagues in the central banking community around the world to go back to first principles. We all want to make the best decisions we can. We've all been burdened with many of the policies that in some sense the Fed created in the 2008 financial crisis. This is a rare moment for us to go back to first principles, ask hard questions, review what we're doing. At the Fed, we've got 5 outside task forces to shed new light on this. And I'm encouraged because in some sense, we each think we're making our own monetary policy, but each of our monetary policies affect one another. And I'm honored to be on a stage with 3 colleagues who have been in the fight for 15 or 20 years with me and without me. And I won't at all be surprised if 6 or 12 months from now, each of us are on a better path to deliver on what we've said we're going to do.
Who's leading these task forces?
We have news to come. I can tell you likely next week who will be the outside experts. Some of them would have been folks in seats like this in prior years. Some would have been academics in the audience. But we really tried to find the best minds in the economics profession among practitioners, people experienced hands, including people from countries outside the US. We're not asking for de Tocqueville to come to America, but sometimes we need a foreigner to sort of see things clearly. And the idea of these is not to prejudge the outcomes. I'm certainly not going to do it. But I think as we make progress on this, I think some of the lessons learned might not just be for the American central banker who's new to this crew, but my colleagues on the stage.
I was going to volunteer for task force.
At the ECB, we went through the same process. And when we started the strategy review, it takes time. And we did bring, under the leadership of Philip Lane, our chief economist, it did take time to bring we didn't call it task force, but we had expert committees, we had groups, and it took a couple of years before we actually settled down and all agreed on the key principles, the reaction function, the elements that we would take into account, the measurements of the nature of the supply shocks and the origin and blah, 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 blah. It doesn't happen overnight. It's complicated. It sounds simple when you're at the end of the supply chain, but the whole process is complicated. So I really celebrate the fact that you're going into this task force exercise and are prepared to let the best minds participate in that.
You know, there's also been a lot of talk here about coordination and influence on each other. And I am curious, President Lagarde, now that you do have a little bit policy divergence, you guys go in maybe in different directions. Is that a good thing, or is that a bad thing ultimately?
The divergence between who and who?
Policy. I mean, you're raising rates, they're not raising rates. You know, is that disruptive?
You know, I totally endorse the comments made by, I think it was both Tiff and Andrew. We started from different places. We were at 2% interest rates. I think the Fed was at 350 thereabout, and you were at 325.
Yeah.
Inflations were at different levels as well, and the markets were expecting cuts in various corners. So it's the situation was entirely different. I don't regard that as a divergence. I think the commitment is the same to maintaining price stability and doing what it takes to actually deliver on that commitment.
But sometimes you see wild swings, and I mean, the dollar-yen, for instance, is at the highest level in 40 years. Is that okay, Chairman Warsh?
Well, before we came here, we each told a small story about Governor Ueda, who's been a great colleague of many of ours, and we're rooting for his good health so that he can join us on panels like this in a couple of months. If this central bank stands for anything, it's staying in its lane on monetary policy. So if you think I'm going to wander into yen policy in Japan, then you're asking way too much of me.
Well, it's making a move, that's all. You know, Governor Macklem, on the markets, you recently, I think, warned about excess, just given the AI trade, speculation. I think that's very much on the market's mind. Do you see signs of that? Thinking of irrational exuberance of the late, great Alan Greenspan.
Yeah, we've been warning really of two things, and I'm gonna draw Andrew into this. Andrew chairs the Financial Stability Board. I chair the Vulnerabilities Committee. So, I mean, you know, as governor of the Bank of Canada, I'm looking at this from a Canadian perspective, but at the FSB, we're looking at it from a more global perspective. And yeah, I would highlight a couple of vulnerabilities. You know, as we've already said, look, there is so much potential to raise productivity growth with the adoption of AI, with the diffusion of AI. But you know, we've seen this before when there's a new breakthrough technology. I mean, the internet proved to be, you know, better than anybody imagined, created whole new businesses. But we still got the dot-com bubble. It doesn't mean there can't be a period where the market gets ahead of himself and you see a retrenchment. So look, it takes two sides to make the market. We're not in the business of giving investment advice as central bankers. But you know, from a financial stability point of view, you look at the sort of, you know, historical benchmarks, PE ratios, forward ratios. Yeah, things look stretched compared to those. So that doesn't mean there's a problem, but it does mean you need to take that risk on board. The other risk we've been highlighting is we've seen very large growth of hedge funds in the sovereign debt market, and to some extent, that's been very welcome. They've been very efficient in buying and distributing government debt. There's lots of issuance out there. Governments need investors. But a lot of this is being done with a lot of leverage, very short-term leverage, and that does make you, a lot of it overnight in the repo market. And that does make you nervous that if there was a period of volatility and you know, haircuts in repo markets went up, or there was some disruption in repo markets, you could get a rapid unwind. You know, again, part of our job is to sort of, markets do a good job of seeing the risks that they face individually. They have a harder time seeing the systemic risks. These trades are very low risk for each hedge fund, but when they're all doing something similar, there could be a systemic overlay. And the idea is if we can point that out, the market can guard against that risk.
So, yeah, I mean, look, Kevin has referred to the financial crisis a few times, and he's absolutely right to do that. And one of the big questions, you know, at that time, or before it, was, is the subprime mortgage market going to be, you know, in a sense, the trigger and the cause of a wider financial crisis? And, you know, we didn't get that call particularly right, frankly. But the thing that we have to bear in mind is what we're trying to look for here is sort of tail risk. You know, is there something in these markets that could trigger a wider a wider consequence in terms of financial stability. And that's, as Tiff said, that's what we're trying to do. Tiff leads the work in the Financial Stability Board globally to do that. So we're absolutely right. So we look at the increase in leverage in core government bond markets. I mean, these markets have changed substantially. I think the thing we've seen actually in the course of the last few months is an increase in leverage in equity markets. So you look at hedge fund leverage in equity markets, you look at leveraged exchange-traded fund markets, those things are changing. If you look at private credit, the questions we're asking is, are those the things that actually can move from tail risk into a broader consequence? So then you have to say, what are the channels through which it can happen? So at the Bank of England, we're doing a second system-wide exploratory scenario to ask that very question about private credit. That's our job.
Do you see any other broader risks emerging? And do you agree with the characterization of stretched for the market?
So we are looking, obviously, yes, we do look at asset valuations because you are living in a world, you've seen this obviously over recent months where you've got quite a divergence between how, bond yields are moving and how equity markets are moving. Now, I think a lot of this comes back to what Kevin was saying about AI. I think it's explicable in broad economic terms. But the question is, is that going to lead to some wider stability issues? So that's on the list. And then going back to what I was saying earlier, I don't want to reopen it again, but frontier AI is obviously high on the risk as well. So we've got quite a list of things that we're looking at the moment.
I wonder if you, Chairman Warsh, see any signs of excess, trillion-dollar IPOs, high margin debt that was referenced, other things that are going on in this market that remind you of those other times.
Well, I would say I've been out of this business for 15 years, but I still have the scars from the global financial crisis. I suspect my colleagues do too. We take risks seriously, and that's part of the reason why each of us, I think, at the core have sort of a reformer's heart on this. What can we be doing in the conduct of monetary policy? How should we be revisiting fundamental reforms to supervision and regulation? How should we think about the payment systems that connect us all? So this conference is principally about monetary policy. I must admit, my first 4 weeks at the Fed, my attention's been focused on monetary policy, but our governments have tended to give us larger jobs than that. We take it all very seriously. I'm not prepared to sort of make a broad comment denoting risks that are available in the system, but I will say this. This is the biggest time of consequence to each of our economies, I think, in our lifetime, maybe absent the shocks of 2008 and the COVID shocks, the dramatic change in how businesses do business, how households are thinking about employment and inflation. And so this is a time we have to go back to first principles. I know at the Federal Reserve with my colleagues, many of whom are here, we're doing that. So I don't want to sound complacent. At the same time, I do want to say, at least for the United States, this is a time of huge opportunity. And if the Fed can deliver on its remit to deliver prices, I've never been more optimistic about what the growth engine of the U.S. could produce.
The growth outlook of the U.S. economy this year is
we're playing Mad Libs now?
Yeah. Fill in the blank.
So I would just say this. Over the last 4 quarters in the U.S., structural productivity is in the high 2% range. So potential growth looks like it's trended up. This is a time that the labor markets, hours worked, are relatively flat. History says that we go from periods of low productivity to periods of high productivity. Nothing is in the bank at this time of consequence. But if the last 4 quarters are an indication, which is really largely before the advent of the new surge in what artificial intelligence can do, I think there's reason to be optimistic. Now, does that optimism convey into policy in the next 6 or 9 months? Still too soon to say.
But strong outlook, sounds like.
You're back to forward guidance.
No,
I'm going to disabuse you of trying to extract that. My view, and my colleagues I think have said this better than I, my view is financial markets and the real economy work best. When you look at what's happening in the real economy, you make your own judgments. There has been a tendency, and I take plenty of blame from this, the 2008 crisis, where we were trying to suppress volatility, where we thought we needed to spoon-feed markets to get out of that. That was the right policy for a crisis. It is not the right policy for the time that we have now. And so sometimes unlearning is harder than learning, and I'm going to keep at it.
Okay, so President Lagarde, how do you think about the best levers to boost growth in the Eurozone right now?
Capital Market Union.
Been hammering this.
28th regime and boost the venture capital. Okay, so that would be on the growth front. But I would like to add one thing. Thanks to the veterans at this podium and a few other people, we have a strong, solid, robust banking system, which is strongly well-regulated, well-supervised. And I think we should be cautious about what we are throwing away by way of simplification. So we do simplify things, and I'm delighted that, for instance, the ECB has done away with 40 different set of declaration disclosures that were unnecessary out of the 130 plus. So we have to go through that process. But I think we have to be cautious about how risks actually move. And risks were squarely in the banking system back in 2007, 2008, when we were all together fighting this global financial crisis. Risks travel fast, and there is no limit to the imagination of those in the financial sector who are trying to make money, as is their business, and who are taking risks. But the question is really who eventually ends up taking the risk and sweeping the mess. So I would contend that this regulatory work that we did at the time, we need to be very attentive, as Andrew suggested, to make sure that the risks that have moved and traveled afar through different structures, bodies, and the different names are also looked at carefully, and that the right measures are taken to protect the public good and to protect the principle of who takes risks bear the responsibility that goes with it.
The other big topic that I know that you all think about and is part of your remit is the balance sheet. And Chairman Warsh, you have talked about before you became Fed chairman, the balance sheet was too big in the United States. So it's at 6.7 trillion right now. What level would you be comfortable with it at?
No forward guidance.
No forward guidance, and I'm not going to give.
Balance sheet.
I'm not going to give. It's the balance sheet. Okay, we're just among friends. We have a task force for that too.
Oh, great. We're going to play drinking game on task force.
I'll say this: there is no secret that from the 2011 period when I was leaving the Fed through now, I wanted the Fed's balance sheet to be smaller, and I long wrote about and described. Interest rates should be the dominant means through which we make monetary policy. If we're in a crisis, there could be a different set of rules. It's always struck me that interest rate policy is the fairest to the broad constellation of our citizens. Interest rate policy, whether we move it up or down, transmits its way into a new mortgage, credit card debt, transmits its way through a lending channel and credit channel. I've always had a view that the balance sheet works mostly through asset prices, works mostly through signaling effects. My 4 weeks at the Fed haven't disabused me of that idea. As we're hearing an alarm, that must be my way of saying that I've gone too far on the balance sheet. But we have a task force that you'll find out of outside people that are going to debate this topic, bring it back to my colleagues and me, to see whether we can have a judgment about whether the balance sheet should be made smaller. The only thing that I'll repeat here, which I've said repeatedly, is if there's a change in balance sheet policy, it'll be a change of my colleagues in the FOMC and the board. Those decisions will be well deliberated publicly, well understood, and will not be implemented until financial markets have come to understand what those are. It took us about 18 years to find our way into this big balance sheet, which again, in my biased view, borders on fiscal policy. It took us 18 years to get out of it. It'll take us more than 18 weeks to bring it down to size. I'm open-minded on the question. We're not going to prejudge it, but I want interest rate policy to be the working oar for monetary policy.
Governor Bailey, you've been focused on the balance sheet. I guess at one point we were asking how big can your balance sheets get, and now I'm wondering how small they can get.
Well, look, there's a nice sort of sense of irony I appreciate from this conversation, because I've been accused of having too big a balance sheet and reducing it too quickly. So, well, really. So can I go back to forward guidance for a moment? Because I've really eschewed forward guidance on the balance sheet. So I really don't step into this world of saying we want ample reserves, we want big reserves, small reserves. My line has always been, we will meet the system's demand for reserves, because that's the system's demand for liquidity. Now, we will also spend a lot of time, by the way, understanding why the system wants the liquidity it wants. And also, you know, the key other point, which Kevin has made very forcefully, is that's the way we actually implement monetary policy, you know, through the short-term interest rate, transmitting out of our balance sheet into the system, and that works very well. So, you know, our world is, look, we will meet the system's demand for reserves. We will seek to understand very closely why it's doing that. The other policy I have is that I want to take interest rate risk off the central bank's balance sheet, because, you know, with a public balance sheet, you know, interest rate risk should be in the market, not on our balance sheet. And so that's why we're moving to a repo asset side of our balance sheet, because that takes the interest rate risk off our balance sheet, which is what should be the case.
You mentioned you alluded to the political heat that you get over this issue. Does that influence the way you think about it at all? I know it's not supposed to.
No, I think we must have, you know, a sensible policy for moving to, you know, a system where our balance sheet reflects the system's demand for reserves. So yes, it went above that level during the QE period. It's coming down to that level. I want the interest rate risk off our balance sheet. Those are the policies we're pursuing, and I think those are the right policies.
Speaking of politics, do you get let off the hook, Governor Macklem, because the Prime Minister used to be in this seat?
You know, we get some free advice from elected officials across the country. And, you know, as I tell them, I appreciate understanding what's going on. It's a big country. I appreciate understanding what's going on across the country, but I don't appreciate telling me what we should do with interest rates. You've got your job, we've got our job, and, you know, that needs to be respected. So I'll just come back to the balance sheet. You know, interestingly, if you compare different central banks, you'll see a pretty wide range of sizes. In Canada, we didn't do QE in 08-09. Fortunately, in Canada, no banks failed. We did get a big shock, but it wasn't so big that we needed to invoke that emergency policy. We did use QE in the pandemic. It's the only time we have used it. But the fact that we only did it once meant that our balance sheet wasn't as big to start with, and we let the bonds run off, so our balance sheet has run back to its new steady state. And if you compare central banks, as I said, the size of the balance sheets can be pretty different. I mean, Canada's balance sheet as a percentage, Bank of Canada's balance sheet as a percentage of GDP is about a third of the Fed's. Now, look, Canada's not the world's global reserve currency, so yeah, there might be some differences here. But I think the results of Kevin's task force is going to be very informative to us. And the other thing I'll say about balance sheets is it's a very inside baseball kind of discussion. It's not the sort of thing most Canadians are really that engaged in. But it does, you know, it is how we, you know, there is an element of how do we implement monetary policy? What is the demand for reserves? We've spent, you know, the last couple days talking about new kinds of money. What do those potentially mean for our balance sheet? So these are questions we need some thinking on.
In the short time that we have left, President Lagarde, I did want to get to you on this political point, and because you have been a forceful voice for central bank independence. I know you continue to do so, and you, I mean, unlike these guys, you have to battle more than 20 different governments and leaders. 21. So you're a pro at that. I'm curious if you think that there are, if you look out and see serious risks to central bank independence, especially in light of the Supreme Court ruling that we got in the United States, letting Fed Governor Lisa Cook keep her job.
Well, I think, you know, the best way we can actually all do our jobs is to be, number one, accountable, number two, independent, and the two come together. You know, when I go to the European Parliament on a regular basis to report on what we do, to explain what we do, that's the counterpart for this independence that we have. staying in our mandate, the entirety of the mandate, is also the sine qua non condition for deserving that independence, which is a precious good without which we would not do a good job. That's my view.
How did you feel about the Supreme Court ruling, Chairman Warsh?
We were doing so well. So before the Supreme Court, the Fed acted independently and followed its remit. After the Supreme Court ruling, the Fed will continue to do so. I read the opinion on the plane over here. One of the secrets of the productivity-led economic growth that I was talking about at the outset is because of the constitutional design in the US. It's the foundational element that has given us 250 years of outperforming expectations. I believe in Article 3 judges. I believe in the rule of law. We'll follow the Supreme Court decision, but day to day, the decision reaffirms what President Lagarde already said. We're calling balls and strikes as best we can. We're taking seriously the reform objective, and we're going to deliver on the high promise that Congress gave us to deliver price stability in the context of our dual mandate. And when we do that, we don't have to worry about politics. We don't have to worry about judicial intervention. We get to look in front of us because it's a challenging step.
Okay, we have a minute left, so I'm going to ask everybody one quickie for everybody. 2 quickies, actually. Governor Bailey, I'll start with you. So favorite economic indicator right now?
Sorry there.
Your favorite economic indicator right now?
Oh, that's a trap question as well. You see, that's a trap question into forward guidance.
Oh, God.
Yeah.
Thank you, brother.
I'm trying.
I'll tell you what, I'll answer it.
Oh, there you are.
My inflation forecast.
Oh, there you go. Governor Bailey, you have to answer.
Well, look, we look at a whole range of data.
Oh, God.
I mean, look, honestly, if you sat through our meetings, you would see more data than you could ever dream of. The other thing I say, look, I'll say this, I spend a lot of time going around the country and I talk to a lot of businesses, and it's absolutely imperative that we stay in touch with the economy.
President Lagarde?
Inflation outlook, balance of risk, underlying inflation, transmission of monetary policy. Thank you.
Chairman Warsh.
I guess I have the last word. With the new
No, I have one more.
with the data project, the data task force, my hope, my aspiration is that 9-12 months from now, we're going to be using new technologies to understand what's happening in the real economy in a contemporaneous, real-time way that positions us as central makers to make better decisions. That we're no longer going to have to rely solely on data that we get from government agencies with mismeasurement problems, that have surveys that are no longer relevant, that every business we know that are leading in our country are using new data sources to make better decisions. My favorite data is upon us, and if we do our jobs, we'll be here a year from now, and we'll say we've discovered data that helps us make better decisions. And we live up to our promises, we strengthen our credibility, and politics stays at bay.
Least favorite economic indicator?
The conventional wisdom that we hear from time to time tells us nothing. Monetary policy works with long and variable lags, as we know, and many of these indicators are echoes of history. We need indicators that tell us what things are when we look out our window today. So when we make judgments, when we next convene, they're as close to real time as possible.
I thought you were going to say the dots, since you didn't do one.
I'm going to let one panel discussion go without me sort of wagering on the dots. There will still be dots for a short time, at the very least, but we have a task force for that, and we'll revisit it.
Do you have a least favorite economic indicator, President Lagarde?
What did you say?
Least favorite economic indicator that gets too much attention.
Those that are wrong.
Governor Mathur, help me out.
You know what I'd say is that especially a lot of the monthly data, it can be very volatile. And sometimes the market over-rotates on the last number. You gotta correlate it with other things. You gotta smooth it a bit. The last monthly number is never gonna be the best indicator.
So I'll give you one that we're wrestling with at the moment and have wrestled with for years, and it's obviously relevant, which is oil and gas futures prices. So, they are terrible indicators in history. The problem is that everything else is also a terrible indicator.
Very good. Finally, you know, when we were coming into this year, everybody was talking about rate cuts. Is anyone still talking here about rate cuts? Show of hands.
Well, that's a nice try. That's a nice try at forward guidance.
All right, I tried. Thank you all very much for the candor and for your service.
I hope you enjoyed that policy panel. I know I certainly did. The Sintra Forum, as we've just shown, always brings together the leading voices of today. Not only that, but we invest in the next generation of economists who will shape the debates that will follow. Our final item of business this year is to recognise the best of this year's Young Economist submissions, as judged by an expert panel, while also taking your votes into account. It's my pleasure to now hand over to President Lagarde to award the prize. Thank you.
So congratulations to all the finalists of the Young Economist Prize. For all of us, you're playing a key role. Not so much because you're going to fund our pension fund going forward, but also because you are feeding us with new ideas, with your creativity, your research, and your energy. So you are clearly important to all of us, whether we are professors, central bank governors, and any other smart, including journalists actually, who have been paying close attention to what you do and what you say. So to all of us, thank you very much. So yesterday we had the pleasure of hearing this excellent group of PhD students, and you shared your research with us. Beyond that, I also hope that all of you had a chance to go and listen to their pitch at each and every stand where they were presenting their views, ideas, and the research that they have conducted. Now, reaching this stage of the competition, I have to tell you, in case you didn't know, is in and of itself, no matter who is the winner, a real achievement. Because there were more than 100 applicants who all were PhD students, all came from the best universities, and they were all very, very good. But you cut that group of the top 10, and you are, as a finalist, a success. So bear that in mind when I'm going to have to give the name of the one who is selected. So your papers actually speak directly to the theme of this year's forum. How do we shape Europe's future? And they remind us how much we gain when we bring new voices, new ideas, new evidence into our discussion. Behind the scene, and to select actually the one who is the winner, it's not just the votes that you all have registered earlier on today. There was a selection committee which has been extremely busy evaluating the finalists' papers. They took into account academic quality, policy relevance, and of course, they took into account the votes of the participants through the online voting portal. I'm going to actually ask them to please stand up when I pronounce their name, because they did the job of reading all these papers. You did not. Well, some of you did, but not so many. So I'm going to ask you to stand up seriously. Jordi Galli, please. Where is he? Is he gone? He went to the loo? Ah. Hélène Ray. Hélène. And colleagues from the ECB, Philip Hartmann, the chair Joao Sousa, and Sebastian Schmidt. Up. Thank you to all of you for this work that you did for us. Now, I would like to ask you, yet again, to applause, because the finalists are going to join me on stage. Please join on stage now. Come on. I think you're supposed to approach one at a time, if I understand. And I'm going to give each of you a certificate that includes your name and the fact that you are a finalist in this exceptional contest. Now, do I hand over now one after the other, or do I announce the one who is winning? Stage director, please. And then only the winner. Oh gosh, okay. I'm sorry for you all. It's a bit grueling, but I have to do that. So, shall I receive them? Okay. So, calling you to join me is Simone Zanella Cavallero. Pedro Martinez Buruera. Max Martinez. Marina Hoch. Congratulations. Luigi Falaccioni. Congratulations. Lennart Nierman. Katerina Nicolecci. Géraud Desazard de Montgaillard. Sounds French to me. And Chen Xuan Shi. So now it's time to announce the winner of this year's Young Economist Prize, who will be awarded $10,000 and a trophy, which is going to be handed over to me now. And the winner is Lennart Nierman. So, just for those who don't remember you, you're a PhD student at the University of Cambridge, and your paper was on decomposing the investment channel of monetary policy. Thank you so much for your contribution, and thank you to all of you as well. So you can stay, you can go, whichever is your favor. I'm just going to give the concluding remarks, and that's going to be short. So we've now come to the end of the 13th Forum on Central Banking in Sintra. This annual gathering has been long part of the ECB institutional fabrics, and I think that there are two reasons why it is so important. First, as the past 2 days have shown, Sintra is where we come to challenge our own thinking. Fresh perspectives and rigorous debate and what lead to more informed, more robust decisions, deeper research, better teaching for each and every one of us. And Sintra, for those who have attended many times, has always delivered that. The themes of past forums have captured the zeitgeist, the opportunities and challenges that Europe faces in each period. This year, shaping the future, innovation, growth and stability was no different. It brought together issues concerning people, technology and policies. We discussed on the stage and on the sidelines a wide variety and range of topics, from productivity to regulation, to financial stability, to migration, to tokenization, to trade. We even discussed the optimal design of dikes. Remember? And thanks to Sarah, we know that AI agents are just as bad as teenagers. And this year's topic cut across so many of the themes that we discussed, and this theme was clearly artificial intelligence. And no doubt we will be discussing that further and deeper in years to come. Some topics at Sintra have been stickier than others over the years. The productivity gap has been one of them, if you look back at the record. And we just keep coming back at it. And as we heard yesterday, AI is likely to be another one of those recurring themes. Now, whether a topic is new or whether it's a topic that we return to, the value of Sintra is the same. The chance to engage with some of the leading researchers in the world on the issues that matter the most, and to bring those insights back into our decision and processes. As a test of that, actually, because I observe very much all of you, there are not many of you who, during the debates, look at their emails. A few do. I see you over there. But very few do that. It means that the quality of the interventions, the quality of the papers, of the discussion, and of the panels are really at a very high level. Otherwise, you would all be scrolling and looking at something else. Now, the second reason runs deeper, because Sintra is a place where we actually reconnect as a community. It's a bit incestuous, granted, but we reconnect as a community. You've all known each other for a long time, and Sintra operates its magic because it's a special place. So we're very grateful to the Portuguese authorities and to our friend Alvaro, who has facilitated all this and brought us actually together. There are a few Portuguese friends in the room as well, and I thank all of them on your behalf. This year we welcome, So there were, as I mentioned on the first day, 11 new governors who joined us in that capacity for the first time, but there were many, many old faces and veterans of Sintra who came back together and welcomed the newcomers in their group. These friendships renewed, these new connections made, make Sintra a hard place to live. Okay, hands up, who wants to go now? None, I knew it. We don't want to go because it's such a nice environment and a place where we can actually pick each other's brain and debate ideas and challenge each other. And it's always difficult to leave friends anyway. There is a word which I learned from my Portuguese colleague, which is in Portuguese, which says exactly that, and it's saudade. Saudade describes this bittersweet longing for someone or something you love, felt more keenly as you prepare to say goodbye. The warmth of the moment already tinged with the knowledge that it is ending. Another way to say, if you didn't call, then I know it's you. So that is why Sintra leaves us with each year in that state of mind, saudade. But you know what? It draws us back to Sintra. So there will be another Sintra. That's the announcement that I want to make right away. And the dates have been set, but I don't have the dates in my briefing material. So, by way of closing, I would like to thank the organizers, the speakers, all of you, those who asked questions, the hard one, and those you thought were the dumb ones, who were always smart anyway. Now, one reassurance I want to give you before I wish you all a safe journey back, after we've had this excellent dinner organized by the Portuguese National Central Bank. I have another set of remarks, which I did not write, which I asked my AI agent to write to wrap up the conclusion of this meeting, having read, because he read, all the papers. It was dead boring. So that's what you stuck with, what I wrote. Thank you.